This is not the typical visit. This is not going to Brussels. This is not going to Rome or even Berlin. It's going to 2 Russian-friendly outposts after France. That perhaps is designed to send a message, not to mention the difficulty. They're going to have dinner tonight. They need to debate things like cognac and EVs.
Yep.
Not an easy visit.
No, and the sort of the subplot or the backdrop to this will be in part Macron trying to encourage Xi Jinping to potentially reconsider their position on Russia. And of course, it is about those subsidies, the electric vehicles. We've had this tit for tat.
Yes.
Of course, I caught up with the Louis Vuitton CEO for alcohol, and he was talking about the dumping of cognac in China, so that you have this EV dumping sort of tit for tat war going on, and they want that to dampen that down, really.
Yep, so they're talking now. Macron and von der Leyen held a bilateral meeting 30 minutes ago. Then they're going to go speak at the China Forum, the China-France Forum, and then again a state dinner. Let's bring in back Kit Jukes to this. So, Kit, again, we're just looking at pictures of this meeting between the different leaders. Obviously, trade for Europe has been a tension point with China. What is the necessity of Europe at a time where we're talking about cuts in June to make sure to get any sort of agreement where we prevent something that looks like a trade war between China and Europe?
Well, I mean, we're in a position where trade is weaker than it was because the Chinese economy is not growing as fast. So Europe has been hit by higher energy costs, which are important, and by weaker trade. In terms of trade shock relative to the United States and a growing growth gap, which have given us different sequencing for central banks and obviously a euro-dollar where it is. So from where I sit, anything that undoes some of that gives the euro potential to go up. It gives Europe potential to surprise on the upside on growth, which is something it hasn't done much of in the last couple of years. So, you know, we saw some slightly better PMIs coming out last week in Europe and slightly disappointing ones in the States. Anything that lets those trends continue will be good for the euro. These are baby steps because the big currents still aren't helpful. The world's not going to freer trade. The Chinese economy is not going back to pre-pandemic growth rate. So we're not going to go back to where we were, but any progress, I think, gets a response in markets because of the starting point we have now of a very strong dollar, very weak euro.
Kit, brilliant stuff as always. Really appreciate your time this morning. Go get the umbrella and make it safe back to the office. Kit Jukes there of SocGen. Okay, coming up on the show, as ceasefire talks come to a halt, Israel's military has begun to move civilians out of Rafah. We're going to discuss that next.
And Berkshire's cash pile hits a new record. More on that story and their position around the equity market right here on Bloomberg. Context matters.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Brief, Danny Berger and Manish Cranny in New York. So Israel's military has begun to move civilians out of Rafah, a possible prelude to a long-expected attack on the Gazan city. This comes as ceasefire talks in Cairo over the weekend seemingly stalled, and Hamas killed 3 Israeli soldiers in an attack this weekend. Joining us now to discuss is Bloomberg senior editor Bobby Ghosh. Bobby, how did we get from ceasefire talks in Cairo to now where we are at this moment of Israel saying you need to leave Rafah?
Well, those rocket attacks overnight are a pretty big deal. I think what we're seeing here is what we've seen before, which is that the Hamas military wing has a different agenda from the Hamas political wing. The political wing is involved in these ceasefire talks. For a while, we thought that the military wing was going to go along with this. But this firing of rockets, you have to understand that at this point in the conflict, they don't have that many rockets. And so it's quite a statement for them to be shooting these off. It's been weeks and weeks since the last time they've been able to successfully shoot off any rockets. Not only have they shot off rockets, they have killed 3 Israeli soldiers, which means Israel, maybe Netanyahu, will feel compelled to respond in force. He has been threatening an assault on Rafah for weeks and weeks now. The Israeli military thinks that this is where Hamas will make its last stand. It believes that there are between 5,000 and 8,000 Hamas fighters in and among more than 1 million civilians in Rafah. So this could get very bloody, very ugly, street to street, house to house fighting.
So you get a sense that this could be sort of the last major conflict. But then where do the people who are sheltering in Rafah at the moment go to? Because those other areas nearby have also been pretty badly destroyed.
That's exactly the point. Now, Israel thinks this will be the last time. We don't really know. Hamas lives among the civilians, as we know. So where the civilians go, quite a lot of Hamas fighters will go as well. They're being asked to go to Khan Yunis, which is a few miles to the north and slightly to the east of Rafah. But Khan Yunis has already been practically razed to the ground. It's heavily bombed for several months. There's very little standing there, where Israel says it wants about 100,000 people to move from Rafah. How the people in Rafah will respond to that, we'll see. There is a risk of stampeding, but there is a risk of arriving in Khan Yunis and finding very little shelter there. It's really hard to see a good outcome to this.
And just to add to the complication, this idea that you were talking about, Bobby, that the senior military leadership and the political leadership have 2 different opinions on a ceasefire, because we know when Israel dropped some of its demands, for example, the top Hamas officials had said they're studying this in a positive spirit. So where do those talks go if there's this fundamental divide between 2 crucial parts of Hamas?
Well, that is the problem. There are enough people on both sides that don't want the talks to succeed. These Hamas rockets are a signal from that faction of Hamas. And then the extreme right in Israel, who are crucial to Netanyahu's government, are going to take that and say, look, this is proof that Hamas is not a good faith actor. It's pointless talking to these people. It's pointless discussing a ceasefire. These people will keep attacking us any opportunity we get. Let's just go in there and try and finish it once and for all, if such a thing is even possible.
Where are we in the broader nexus? We have Jake Sullivan talking about an agreement, a Saudi defense agreement, but that defense agreement, which the Saudis want, are pretty desperate to get that defense agreement for as long as Biden is in office. But they're co-joining this with, as it were, an integrated vision of peace in the Middle East. It's a little bit of a tall reach right at the moment, given the landscape you've just laid out on the ground.
Very much a tall reach, Manos. I was in Washington over the weekend. I was at the event where Jake Sullivan gave these remarks, and the Biden administration are trying to attach these 2 things together, a deal with the Saudis, and they're saying to the Israelis that as part of this deal, you can get normalization with the Saudis. Now, the Saudis at this moment are not making any such commitments in the open. They want a defense deal with the U.S. And the longer this goes on, the more strength the Saudis will have to be able to say to the Biden administration, look, we've gone along with these plans long enough. It's clear that the Israelis don't want to come along. Let's make this deal. I have a sense that the Biden administration is painting itself into a corner with the Saudis and will pretty soon find itself in a position where they have no choice but to make a deal with the Saudis, whether the Israelis come along or not.
I mean, I just wonder how much this is shaping the broader Middle East, because you see, for example, over the weekend, Iran's supreme leader tweeting basically the U.S. college protests, saying, look how much of a mess the U.S. is, look how much support there is for us and our cause. Is this a big narrative shift in where the power and where the, I guess, the goodwill is right now in the region?
I wouldn't worry about Iran so much in that context. I mean, this is a man, Khamenei, who only a couple of years ago slaughtered thousands of his own students, his own young people, when they were protesting about something much simpler and much easier for him to give. He chose not to give and instead to send out his goons to murder and torture and imprison thousands and thousands of young Iranians. The concern is what's happening in, this is an old cliche, but the Arab street. Ordinary Arab people, even though many of them don't necessarily live in governments upon whom they can really put any pressure.
Yeah.
There is pressure building in the Arab street. All these images for months and months that we've seen coming out of the Palestinian territories are sort of evoking a sense of rage that at some point has to come out. Something's got to give. If it doesn't give in Rafah and it doesn't give in Israel, then it might as easily give on the streets of Cairo or the streets of any one of the Arab capitals.
Okay, thank you very much. We're tracking the story. Let's see how it evolves over the next 48 hours. Bobby Ghosh, right here on Bloomberg this Monday morning. Context matters.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
It's Bloomberg Brief on a Monday morning with me, Manus Cranny, and Danny Berger. Let's set your agenda for the front pages. This is what we're looking at from the headlines around the world. First up, we have the New York Times, Israel shutting down the local operations. Now, this is of Al Jazeera on Sunday. It's part of a broader crackdown on the dissent over the war in Gaza. Netanyahu is accusing Al Jazeera of harming Israel's security. Al Jazeera called the decision a criminal act. Shutdown order, 45 days with options to extend.
Well, I saw this one on the front page of the FT, and I knew you'd like it, Manus. So here we go. Finally, the CEO of Credit Suisse is going to be leaving UBS. It's Ulrich Körner, and he had asked to actually leave earlier, but they basically convinced him to stay on until the acquisition and the merger was complete.
Yeah, and of course, there's no irony lost on anybody. He joined UBS in 2009, joined Credit Suisse, then he switched to UBS. We thought he was going to be the CEO after Oswald Grubel, and then Armotti got the job. But Starbucks, when you're a big shareholder, Danny, you've got swag. Howard Schultz.
Yeah, writing in a LinkedIn
former CEO,
post.
I should say.
I feel like it's like the ex-boyfriend coming back and telling you how to run the relationship. But yes, he wrote this long LinkedIn post, not that long actually, basically saying, focus on the customer, upgrade your app, and everything will be all right.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Israel's military has begun moving civilians out of Rafah, a possible prelude to a long-expected attack on the city in Gaza. Berkshire's cash pile hit yet another record as Buffett says Apple will remain its top holding. And investors search for more central bank clues with the RBA, the BOE decisions due this week.
Well, man, this is the sideways market finally moving upwards. We've just off the back of the best two-day rally for U.S. stocks in 10 days, thanks to the narrative shift, the narrative yo-yo of the central bank, this time being friendly for risk assets, up 0.25%. U.S. bond cash market is closed at the moment because the U.K. is closed. That should open around 7 a.m. U.S. time, but bond futures for the moment do have a bid coming into them. We're off the back of the biggest upward move for downward move for U.S. Treasuries of the year. And then the yen. We're undoing a lot of the moves that we saw last week. The relief that came after the weaker jobs, we're now higher on dollar versus the yen by about 0.5%. We're speaking to Kit Jukes earlier, Manis, who basically said, look at the CTFC data after we got the intervention. There is still a buildup of shorts. It is clear that the BOJ, the MOF, have not washed those out of the market. In terms of effectiveness, there's a judge right there. It hasn't been effective if those shorts are still clinging on.
Yeah, he also made the point that the sheer scale of the intervention over such a short, confined period of time relative to 2022, hence the reason why he tries to put an amalgam around this, which is the size and scale. And that's when he says it's perhaps one of the biggest and most substantive interventions that he's seen on record. But then, of course, Yellen pushes back. She talked about these interventions as something that should be sort of rare, and she was suggesting that this intervention was nothing more than a rumor.
Yes. I mean, it's unfortunate for the Japanese because not too long ago, she was basically endorsing intervention alongside Japan and South Korean policymakers. And now she's saying, look, it should be rare and it should be within consultation. That is not a ringing endorsement, Manis.
No, and the one thing that Kit did say, Kit Jukes from SocGen, he said, look, this intervention, if it is intervention, caveat, has not scared the market. It has not frightened the horses, which are the carry trade. They are still very much emboldened.
Well, maybe they have the benefit of a slowing U.S. economy. I want to pivot to the U.S., Manis, and get to our next guest. It is Ruqaiya Ibrahim, strategist at BCA Research. Ruqaiya, thanks so much for joining us. Look, it's been quite the year already so far, and it's only May somehow, but a lot of folks who'd predicted recession this year and last year have felt burnt. And now we're pricing in a soft landing. We're pricing in 2 Fed cuts. But Ruqaiya, you write that the odds of a recession starting late 2024 and early 2025 are elevated. What are you seeing that suggests that?
Hi, Danny. Thanks for having me. So I think as we get into a recession, it's first going to look like a soft landing. We're shifting in narratives from, the no landing phase. Now we got this week jobs report on Friday, so it's kind of shifting towards this soft landing narrative. But I think as the unemployment data deteriorates, as the unemployment rate rises, as the labor market deteriorates, we're already starting to see things like the jobs openings rate, the hires rate, the quits rate. These things are all falling. So as this trend continues, I think the narrative is going to shift towards this, a recession outlook. And so, I think that there's still a runway for the soft landing narrative to continue over the coming months. But eventually, the unemployment rate is going to tick higher, and that's going to lead to concerns about a recession.
Ruqaiya, good morning. Well, if this goes forward, as you said, we've got a little bit of runway for soft landing, but it does challenge, to use the FX parlance, it challenges the carry in FX and the exceptionalism of the US. So therefore, from an equity point of view, is it just a marginal slowdown, drawdown in equities? Is it a 3%, 5% drawdown on the scenario that you paint? Or is it something more significant that challenges the exceptionalism of US equity?
U.S. equities are already extremely highly valued. And so I think that raises the likelihood that they're more vulnerable to the downside. In our expectation, if we do get this recession late 2024, early 2025, the S&P 500 is most likely going to fall to around 3,600. And that's due to our expectations on growth estimates and on the forward PE. It's already at 21. That's highly valued. So I think it's going to come back down to something that's more of where it was in the 5 years prior to the pandemic. And that would put us at around 3,600 for the S&P 500.
3,600. I mean, that is a painful sell. If I'm trying to see how much that is quickly, that's about, what, 30% lower, a little bit less than that, Ruqaiya, if we get that kind of decline. I mean, that is a big difference. Just walk me through what the world looks like with S&P at 3,600, because Ruqaiya, we're going to get a U.S. presidential election. We're looking at what that might mean for inflation. That is big.
Yeah, I mean, to be clear, our expectation is it can go down as low as 3,600. And so, there is potential that it's not going to fall back that low. But I mean, in this environment, what we're going to see is that the euro area is right now, it's starting to recover a little bit. And so I think that there is this runway for it to improve a little bit ahead of a recession. But ultimately, there's going to be this headwind from China. We don't expect the Chinese policymakers to stimulate aggressively. And so, they haven't really signaled that there is going to be enough stimulus to really revive the Chinese economy. And so any sort of recovery that we see in the near term in terms of the global manufacturing cycle, that's going to be short-lived. And, the global economy is going to ultimately, I mean, we don't expect a very severe recession, but a garden variety recession is what we expect. And that's where we would pin that 3,600 floor at.
It's interesting because many people have not spent a great deal of time talking about China in regards to the US exceptionalism, but you are co-joining that inability to deliver a robust 5% growth in China as something which eventually permeates into the US and global perspective. More European than US?
Yes, definitely more European than U.S. I mean, Europe is much more exposed to China, of course, than the U.S. But the point being is that, right now, there could be, over the near term, some optimism about a global manufacturing recovery. We're seeing things like the global manufacturing PMI break above 50 for the past couple of months. And, that could sort of prolong the optimism. But eventually, because China is not stimulating aggressively, there are still headwinds in the euro area, and that's going to prevent any durable recovery in the global manufacturing sector. So yes, China, of course, is much more relevant when it comes to discussing the euro area than the US. But the point being that, the euro area will not be able to escape a recession if the US falls into one. And so, this is a global phenomenon that we're expecting.
Yeah, right. The whole US sneezes, the world catches a cold. Rukaya, Bank of America points out that the amount of junk bonds that are currently trading as high-grade securities are at a record. Given what you're saying, the weakness we could see in equity markets, that we're heading into a recession, are vast parts of this market, many corners, just sleepwalking through a possible painful default cycle?
Yeah, that's what we're expecting. I mean, if you take a look at what's happened to credit over the past few months, I mean, the default rate expectations that are embedded in those valuations are extremely optimistic. And so I think that, as for now, the U.S., let's be clear, the U.S. economy is still doing well, but we are seeing concerning data, like I said, from the leading indicators of the labor market. And as we see this data, continue to point in that direction and lead to a rise in the unemployment rate and this recession narrative takes hold, I think that's when, these other parts of the market are going to wake up to that risk.
Okay. Rukaya, thank you very much for being with us this morning. That's Rukaya Ibrahim of BCA Research. Pretty mighty call there if it does go according to the call, 3,600 on equities. Coming up on the show, as ceasefire talks come to a halt, Israel's military has begun moving civilians out of Rafah. We discuss. That's next. Context Matters on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
This is Bloomberg Brief. I'm Manish Kani with Denny Berger in New York. The ceasefire talks over the weekend seemingly stalled, and Hamas killing 3 Israeli soldiers in an attack this weekend. Israel's military has begun moving civilians out of Rafah as it weighs the timing of a long-awaited attack. Joining us now is Ros Matheson. Ros, I mean, we've just caught up with Bobby Ghosh a little bit earlier, and the conversation seems to be around one massive last moment, as it were, of an offensive. How imminent is that, given what's happened over the weekend?
Well, it's unlikely to be that imminent, because what Israel needs to do is actually relocate a lot of people out of harm's way, and that involves dropping leaflets and then coaxing people to relocate. And the question is, where exactly do they go? What we know for now, it's really an order to move people out of one part of Rafah, essentially to a northern part of Rafah, but there's a lot of other people still left in the area. This could take days or weeks to move people entirely. We don't know exactly what the Israeli government's timeline is on this, exactly when they intend to go into Rafah, but they do also need to be very mindful of the risk to civilians in the area, and certainly the US, Europe and other countries have been pushing on that front. So this is something that could take quite some time. It could be a slow walk towards an offensive, and then when it does come, it could be much smaller in scope than we thought it might be, say, 6 to 8 weeks ago.
It's a clear tone shift, Roz, because it was early in the weekend that we had heard that there were the talks in Cairo between Israel and Hamas towards a ceasefire. And then this happens, and then a rocket is fired. You have deaths among IDF soldiers, and you have Israel describing the talks as a crisis. How far away does that mean we are from anything that looks like a ceasefire?
Well, certainly those talks are going to go on, although it's unclear if Israel's going to send another delegation to them. And they've been really fraught throughout, as we've seen. There's no goodwill really on either side. There's been fundamental differences about what the terms of a ceasefire would look like, particularly if a ceasefire is meant to be a springboard to a full end to the conflict. Where do the Israeli soldiers go during a ceasefire? What happens to the Israeli hostages and Palestinian prisoners being exchanged? There's a lot that's been fundamentally problematic the whole time. What we know now, of course, is that those talks are really, really on a knife edge. There doesn't seem to be any momentum. Is this effort to move people out of Rafah on the part of Israel designed to be a point of leverage to try and get a ceasefire, to force Hamas to get to the point of a truce? That's also a prospect. But at this point, it doesn't seem like a ceasefire is imminent.
I suppose it depends on what Netanyahu believes he has globally as support. Today, we understand Biden will have lunch at the White House with King Abdullah of Jordan. And again, is this another scenario where Netanyahu pushes forward, escalates the assault, the military effort in Rafah, but it really tests where he is globally with the White House and his allies?
Well, that's kind of been the dynamic throughout. Of course, it's a bit, Israel's been a bit more attuned to some of that global pressure in recent weeks. They certainly have slowed down what we thought was going to be a Rafah offensive some weeks ago. He's been a bit more mindful of that. But equally, Israel's never walked away from that rhetoric, which is that they need to go into Rafah because they feel they want to eradicate Hamas completely, and that's the only way to do it. That's been a consistent goal of Israel throughout, despite the international pressure. And so it's very clear that they will still do what they think they need to do to meet that goal, regardless of what the rest of the world has to say.
Okay, let's see how it evolves over the next 48 hours. Ros, thank you very much. Ros Matheson in London, tracking the latest developments in the Hamas-Israel war. Turn our attention to the US, to Omaha. Berkshire Hathaway's cash pile hitting another record, $189 billion. Scarcity of deals seems to be the narrative. Let's take a listen to Warren Buffett and what he had to say at the annual meeting over the weekend.
We will have Apple as our largest investment, but I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive.
Still going strong, Warren Buffett. Sonali Basak joins us now for a conversation around this. I mean, there's some very poignant moments in this entire piece of theater in Omaha, but when it comes to the reality for investors, it's about cash, and it's about who never said thank you for earning a few dollars in cash. $1.9 billion is what they've earned on the cash piles. So it's not exactly languishing and not doing any good, is it?
That's the good point to make here, because over the last several years, of course, that cash pile has slowly expanded, and a lot of criticism over how quickly Berkshire could put that cash pile to work, especially now that they have more competition in the private equity community than they did in prior years. You didn't see Berkshire, for example, really put a lot of money to work the same way some of those private equity rivals did during the COVID downturn. So were there missed opportunities? On the other hand, you have to think about the reasons this cash pile is growing. One, to the point that Vanis is making here, is that they're earning more income on that cash. Of course, cash is worth more, but also they're taking profits in certain places, and also their operating earnings are up almost 39%. They brought in more than $11 billion. So billions of dollars brought in the door. Now, the question is, how do they make decisions about putting that out the door, and how steep of a correction do they have to wait for before that could start to happen?
He also talked about Apple, and a lot of the narrative around Apple had been, okay, they have problems in China, but another thing people said was, well, Warren Buffett has turned his back on Apple. He sold $40 billion worth of Apple. Clearly something is wrong. He did not say anything was wrong in this, did he?
Yeah, he defended Apple pretty significantly. And remember, when he made that bet in the first place, it was remarkable. Berkshire had been, let's say, somewhat tech-averse, or very tech-averse in a lot of ways when he bought Apple. But now he said you could still expect it to be its biggest holdings. He hinted at the idea of tax implications here for the reason to be selling it. He was talking about this 21% tax rate that Berkshire currently sells, and to be able to sell it now with the thought of taxes going up in the future for corporations and investors, you wouldn't be so upset if you think taxes are going up to be selling it now. He also said that it's really a better company here than a lot of his holdings, including some of his favorites, Amex, Coca-Cola, though he praised those companies as well. So don't cry for Apple. Berkshire's still holding it and holding it strong through the end of the year.
Yeah, American Express and Coca-Cola are wonderful businesses, and Apple is an even better business. We will own Apple when Greg, of course, he turned around. It was that sort of moment where he turned around and referred to Charlie, but of course it was Greg sitting to his left. We will have Apple as our largest investment unless something dramatic happens. Well, let's hopefully AI comes along and changes everything for everybody. The insurance side of the business is just throwing off money, but then you've got the railways side of the business, which was a little bit more of a question mark. What gives?
A few things. You have to think about just how many businesses within the railroad BNSF business did face pressure. You even had Greg Abel, who of course is the heir apparent to Berkshire, really say that they were not happy, that the results were disappointing, he said. Now, you had certain parts of the business, including the coal business, for example, revenue dropping about 26%. You have kind of structural issues throughout certain parts of the business here, just benefiting from pricing pressures across the business, railroad as well, per unit pricing under pressure. Now, turning that around, remember, this is not only a business that really benefits when you have volumes crossing those railroads, it also competes with the trucking businesses as well across the United States.
I'm sitting looking at Sonali, and I'm hearing trucking and insurance, and I'm thinking, this is not Wall Street. This is the woman that covers a breadth.
It's real economy
it's real
business.
America.
But that's always been the point of Buffett, right? And why people, when they looked at his cash pile, were like, is this a sign that Buffett doesn't believe in America?
But think about how much pressure this puts Greg Abel under. founder. Remember, there are not only questions about the operating businesses, he's the successor now. And without Charlie Munger there, to your point, he really turned to Greg Abel a lot and Ajit Jain to answer some questions and really make a bigger mark at this annual meeting. One massive moment was when he was really asked whether Greg Abel would have more control over the investment portfolio and the investment operations. They kind of skirted this part, but ultimately the decisions come down to Abel in the future, though it would also be contingent to the board. The culture of Berkshire would also be put on Abel at the end of the day. So a lot of questions about how Greg Abel will run Berkshire in the future as succession is top of mind.
It's so interesting because we thought, okay, this gives us a glimpse into what Berkshire looks like without Munger, but what you're saying is it actually gave us a glimpse of what it looked like without Buffett. What did Buffett have to say in a post-Munger Berkshire?
The last word that he had at the annual meeting is, I hope I'm here next year. And so, you know, there was a lot of acknowledgement about the succession of Berkshire. Remember, this has been a succession story that has been more than a decade in the making, and a lot of those executives there have been there a very long time. Now, Berkshire has always deferred, or Buffett has always deferred to his deputies when it came to their business lines. But there are moments, you think about Paramount, for example, Buffett had the final say. And so when it comes to Greg Abel, do investors trust him to have the final say? There's a lot of eyes on him.
The journey is this, the challenge is this, is that Warren Buffett and Charlie Munger were an American icon institution for as long as I've been around, and that's a hell of a long time, going back 25 years. Well, no, but going back to, you know, 25 years ago when you covered this event.
Yes.
Okay, at another institution that shall remain nameless. It was the almost zenith of the year. So what we need is to get to know Abel.
Right, but
that's the problem.
But in some way that Buffett has been so highly influenced by Abel. You mentioned this, that Apple, the tech is such a good example of Abel having big influence.
But remember, that was Todd Combs and Ted Weschler too. Remember the stock pickers. Right. So Berkshire does have a huge bench under it, but to the point Manus was making, Charlie Munger and Warren Buffett were American icons, right? They were...
Go America.
Go America. Although they are expanding around the world in increasing form.
See, Manus is assimilated, full American now. He gets it.
I'm global.
Welcome to New York, Manus. I think.
Shanali, thank you so much for joining us. Really appreciate your time, Shanali Basak. Okay, coming up, we're going to get you set up for the week and look at what's on deck. We got some Fed speakers and some big auctions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. Let's get you set up for your trading week. We're going to get a fresh round of corporate earnings. Disney, UBS, and BP all report this week. Then we get a Bank of England decision. That rate decision happens on Thursday. And we're going to round out the week with more data, Manish. We're going to get you, Mitch, consumer sentiment on Friday.
Yeah, let's see. Does that add to the cracks in the dam from the services data that we had on Friday? Some stocks to keep an eye on. You got Warren Buffett heaping praise on Apple after revealing that he'd actually cut his stake. Stocks down 1% this morning. You got Palantir AI options spur more commercial sales as it reports earnings after the bell. And then Coinbase, you've got at the bottom of your screen, you've got Bitcoin bid up this morning 2.25%, and Coinbase up 3.89%. All boats are rising on that tide. Danny.
The boat that is not rising on the tide is the yen. A quick check on that, Manish. We are back above 153, and we are weakening by about 0.5% versus the dollar, giving back some of the Friday gains after that weaker jobs data. After 2 days of intervention of $58 billion spent, is it a waste? Kit Juke says they have not washed out the short positions yet.
Yeah, I mean, look, Kit talked about the size and the scale of this intervention, and in his view, and that's SocGen, it was perhaps one of the most powerful interventions that they've ever seen. The question is, the carry trade has not been washed out, and if the carry trade is not washed out, then we may just retest 160.
And unfortunately, they don't seem to have the support of the U.S. Yellen saying that intervention should be rare, and they should be consulted on it. Yet not a ringing endorsement. All right, that's it for us. Surveillance up ahead.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
very hard for me to see, given everything we know, a hard landing scenario playing out anytime soon.
The equity market has been, much more resilient to these shifts in the interest rate narrative.
You have to give markets the benefit of the doubt here, irrespective of what the data looks like.
At some point, you will have to pay the piper. Fed policy has only become really restrictive relatively recently.
This volatility, which we are continuing to see in rates, risks breaking something elsewhere.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started, coming off the back of a second week of gains on the S&P 500, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, your equity market on the S&P 500, positive here by 0.25%. The calendar is super light this week for earnings, for data. It is super heavy for Fed speak. Check out the Fed speak through the week. You'll lose count of how many scheduled speeches there are. The highlight today is the New York Fed President John Williams following a downside surprise on Friday on payrolls. The question, Bramo, are we quickly reintroducing summer rate cut talk after that jobs data?
If they do, how much do they risk kind of exacerbating some of the volatility that we've seen in markets in a way that isn't really conducive to any sort of policy? At what point are they going to risk some sort of credibility gap if they really start talking about rate cuts after trying to push back so aggressively 2 weeks ago?
A favourite quote from Citi, Andrew Honhorst, and we'll catch up with Veronica Clark a little bit later this morning. Summer doving happened so fast. You can sing that a little bit later. I'm not going to sing it right now. Nobody wants that. But this is a big, big question, how quickly things have changed off the back of one downside surprise. And to be fair, it hasn't just been one. If you look at the economic surprise index coming out of Citi, the US economic surprise index, it's just dropped into negative territory. If you look at the performance elsewhere outside of America, it's starting to build just a little bit. And I think a thing we've got to get through this morning, have we seen peak US exceptionalism? Will we see more guests around this table talk about convergence versus divergence?
Peter Scheer put it best. I like my exceptionalism to be exceptional. He came out and he was talking about how it's really important for the U.S. to kind of be alone, for people to really buy into the U.S. story. It's very hard to understand whether the inflation is the same in the U.S. as it is in other places, whether it's really coming down as quickly in all of the places. But to me, I think that probably the week starts Thursday, or maybe it never starts, but Thursday we get the Bank of England decision. I think it'll be interesting to see how they kind of parse through some of the less exceptional aspects of their economy and how they're going to respond with the rate perspective.
Another classic Bramo promo for the week ahead. Don't tune in until Thursday when you hear from Governor Bailey on Threadneedle Street. We also have to talk about the range we saw in the bond market. Let's take the front end of the yield curve on treasuries last week. The 2-year, the high on the 2-year was post-ECI. It was on Tuesday. It was 5.04%. The low was on Friday in the low 470s post-payroll. So we're talking about a 30 basis point plus range on a 2-year yield. Mohamed El-Erian's talked about it a few times, just how hypersensitive this market seems to be to incoming information because of the Federal Reserve's reaction function. Now, we've got to ask ourselves, do you think that is a feature of Fed communication or a bug?
You know, and I don't know the answer. I don't know if they have an answer either. I think that probably each individual Fed official has a different kind of perspective at a time where ultimately they don't know what they're going to do. They don't have a framework, as Mohamed El-Erian has put out there. We don't have a sense of the longer-term trajectory of baseline rates. That actually was an area that Jay Powell steered away from completely in the conference. So if you don't have a sense of what the destination is, how do you even understand how to calibrate the journey?
If you're confused by Federal Reserve communication, there's going to be more of it through the week. I'm not sure if that helps or harms the cause. Equity futures right now on the S&P 500 positive here by 0.25%. Remember, it is a bank holiday in London, a holiday in Japan, so cash treasuries haven't started yet. We will get that opening in the next hour or so. At the moment, looking at bonds, yields are lower by 5 basis points at 2.44. Outside of that, in foreign exchange, the euro a little firmer at 107.69, and crude in the high 70s here, Lisa. We're positive by 1% at 78.99.
All right, this week, very exciting week. It's not a very exciting week. There's kind of an absence, as John was saying, of U.S. data. We do get the SLOOS, the Senior Loan Officer Opinion Survey, today. We also hear from Fed's Tom Barkett and John Williams, who will be speaking at the Milken Conference in California, which we will be hearing from a lot of luminaries there as well. Tuesday, we get earnings from Disney, Lyft, Spirit, Aerosystems. Fed's Kashkari is also speaking. Just want to point out, about 90% of the S&P has already reported earnings. So we've really gotten a good sense of what is going on. On Wednesday, we hear from, you mentioned Jefferson, Collins, and Cook. We also get earnings earnings from Uber. Thursday, the big day, Bank of England decision. We also get jobless claims, and on Friday, University of Michigan sentiment survey. I will just add something else. We get a slew of bond auctions, and this might be the most important part of the entire week.
Yeah.
We get something like north of $100 billion of auctions starting tomorrow with a 3-year auction.
I've never seen an American so hyped up about a Bank of England rate decision. Greg Battle, have you ever seen that before?
No, I think that says something about the number of catalysts and information we get.
Thank you. And do you disagree?
Okay.
Not really, no.
Coming up, Greg Battle of BNP Paribas with stocks climbing as traders revive Fed easing bets. Greg Vadier with tensions rising in the Middle East. And we'll catch up with Luigi Vingales of the University of Chicago on U.S. exceptionalism. We begin with our top story, stocks extending gains as traders focus on the prospect of Fed rate cuts. Greg Battle of BNP with this to say. Over the last month, 80% of the S&P 500 by market cap have reported earnings. Whilst there were some notable misses and rotation between winners and losers, the net read was positive, with revisions higher to EPS numbers for 24 and 25. Greg is with us around the table. Greg, hello. A proper good morning to you, sir. Back in March when we caught up, you said the bigger risk to the market was hot data. We're not getting hot data. Is this good?
Yeah, I think so. I think we've gone from an environment where the data was too hot. We said it was too hot to be too bearish on earnings, but it was also too hot to get too carried away of equities because we've got this counterweight from the rate market and what was going on with the Fed. So I think we've moved from an environment where the data was too hot to starting to cool down. The initial leg of that, at least, is positive.
Forgive me for getting into children's fairy tales so early in the conversation, but Goldilocks was mentioned a few times on Friday. Does it risk getting too cold too quickly?
I think it can do, but I think it's very hard for it to go directly from too hot to too cold. So you do get that bit in the middle where it does feel just right. That can be pretty short-lived, but for now, at least that feels like where we are.
Do you believe in the sort of spreading out of exceptionalism? Let's not focus on the U.S. because nobody else is this week because we're not getting any data except for the Fed officials who are going to speak. Do you think that we truly are seeing a broadening out in this story of immaculate disinflation?
Potentially in the short term, but I think it can be quite tactical. So we've had some policy tailwinds from China, which I think has helped the rest of the world, ex the US. I think we've had the bull run from US equities driven very much by tech and the AI story. And I think that's a secular theme that makes the US stand out on a structural basis. But I think from a more tactical view, we are potentially seeing a bit more convergence, a bit of a catch-up trade from some parts of the market that have lagged.
So do you find at this point that some of the areas that have led are kind of shifting and becoming laggards, and that actually there is a big rotation underfoot that feels sustainable to you, not just necessarily a broadening out, but away from big tech, away from just U.S. big cap, large cap focused, toward the rest of the world, toward consumer cyclicals?
I don't think it's necessarily sustainable on a longer term view. I think this is a bit more of a tactical reversion from those parts of the market that have lagged into what could be a bit of a lull in terms of the summer, where we've already spoken about how light it is in terms of catalysts. So that is an environment where you do get mean reversion.
There's one way, or rather two ways, a spread can close. Something can get better or something can get worse. When we start to talk about convergence over divergence, are we talking about something improving or something getting worse?
Yeah, it feels like it's a bit of a catch-up trade from those parts of the market that have lagged. And that's not just globally. I think you can also look at some of the lower quality parts of the market in the US that have lagged. And that's very much linked to this story of, pressures easing up a little bit from the rate side and that Goldilocks narrative.
What tells you it's not durable, that it's just sort of a tactical short-term trade?
Well, I think part of it is just you need to think about what is driving this structurally. And we've been in an environment where I think the key driver for US equities has been earnings, and that has been driven by large cap tech and the AI trade. And it's not obvious to us that we're at a point where we can call time on that.
You don't sound very excited about this week, do you?
I'm not very excited about this month, or maybe this entire summer, if I'm honest. We have an environment where we look backwards. We've had that glut of S&P earnings. We've had some kind of pivotal moments from the Fed, from the macro data, payrolls, ISM. When we look forward to the next month, there's a couple of catalysts that stand out, but outside of that, we really think we could have a mid-year lull.
How about bond auctions? Is that where the fireworks are?
I think potentially not. I think given that the data we've seen this last week, we're potentially in an environment where we're going to get less volatility transmit from the bond market to the equity market rather than more in the coming weeks.
Is this basically the result of people just having no conviction and being whipsawed so much and having so much narrative creep and narrative shift and narrative swing that they just are exhausted? And they're just basically like, we're just going to sit this one out.
I think low conviction and positioning. So we think we saw a real washout in terms of positioning over the last month that has maybe de-risked things a little bit on the downside. And then I think to John's point, people are a little bit worried about. You go from too hot to too cold. Maybe it feels okay in the middle, but it's something that's really hard to have conviction on when the narrative is shifting so quickly.
You two deserve each other. I've never heard such a boring start to a Monday morning. Honestly. Should we talk about the election? Let's really make it interesting. When do you think is going to be that point in the calendar where you arrive around this table and it just feels natural for us to ask that first question about pricing in the US election?
I think it's going to be after the summer. So, whether it's August, whether it's in the months coming into the election. When you look at it statistically in election years, what you do tend to have is a real lull in volatility through the summer. And then things pick up a bit more in the kind of coming months. So I think at the moment it's a topic that every meeting I'm going into with clients, everyone's talking about the election. And when you ask people how they're positioned for the election, generally the response is not yet.
What's your response? How do you tell them to think about the risks on the horizon?
So I think there's several ways we can look at it. One is like what's priced in terms of the volatility market, and it's clear that there's a very big kink in the options curve around that election date. And then the second one is thinking about rotational trades. What are the relative winners and losers potentially for the election trade? And are there any of those trades that we like in the steady state in the kind of months running up to that, as well as just for a pure election trade?
Well, I will say that right now you mentioned China as sort of the bleed through to the rest of the world, including in Europe. And Chinese President Xi Jinping is currently visiting Europe. Yeah. Are you watching that? I mean, how much do you sort of gauge what that kind of interference is going to look like? How you sort of price in fraying connections at a time when we've heard a lot about this and not a lot of action?
Yeah, so I think that the kind of deglobalization trade is one that we think is interesting to run through the election. And it's something that I think is, seeing the data that we've seen the last couple of weeks and seeing some of the kind of pro-cyclical policy responses and subsequent market reaction from China equities, I think it's something that's interesting. And it does drive some of that kind of convergence, not only globally, but within sectors. So we think some of those kind of commodity sectors, linked sectors, industrial cyclicals have performed a little bit better. But as we run into that election, I think that, tariffs, trade, deglobalization, those are going to be big themes for the market.
Greg, good to see you. Thanks for dropping by. Greg Battle of BNP Paribas getting your week started with equity futures right now, positive by a little more than 0.25% on the S&P 500 with some stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israel's military has begun moving civilians out of Rafah. It's a possible prelude to a long-expected attack on the Gazan city. There are more than 1 million citizens sheltering there, many of whom fled after the initial outbreak of the war. There were ceasefire talks between Israel and Hamas over the weekend, but they appeared to have stalled. The main sticking point is Hamas's insistence that any truce be permanent. Credit Suisse's CEO, Ulrich Körner, is set to leave UBS in the coming weeks. People familiar tell us Körner had hoped to leave the business sooner, but he was persuaded to stay on until after the legal merger was completed. He was also the only Credit Suisse executive to gain a board seat, but during the integration kept a low profile. Now, cocoa prices may have subsided, but now a new supply crunch is roiling commodity markets. It is coffee, Robusta coffee, climbing to the highest price in 45 years. That according to the International Coffee Organization. Last month, prices rose 17%. It is the supply crunch that intensified for a variety of coffee used in espresso blends and instant drinks. It's blamed by poor harvests in Vietnam, and now a drought and a heat threaten upcoming harvests. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. We'll catch up with Danny in about 30 minutes' time. Up next on the program, the yen, back under pressure.
What the yen has going for it is it's ridiculously cheap on any kind of effective exchange rate valuation. What it has going against it is the interest rate differential is still absolutely vast.
A weaker Japanese yen this morning. Dollar yen at 153.70. That conversation up next. Live from New York this morning. Good morning.
more capitalism's next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
What the yen has going for it is it's ridiculously cheap on any kind of effective exchange rate valuation. What it has going against it is the interest rate differential is still absolutely vast, and the cheapness of the currency hasn't turned up in awesome export data. By and large, it's turned up in a lot of tourists arriving in Japan this year to admire cherry blossom and things.
Here's the latest this morning. The yen whipsawing into losses today, erasing Friday's gains that saw the currency jump as much as 1.2% on soft US jobs data. Investors now shifting their focus back to Japan's interest rate outlook. Mark Chandra of Bannockburn writing this: Japan remains on holiday today, but the lingering aftertaste of the 2 bouts of material intervention last week has subdued the momentum traders and trend followers. Mark joined us now for more. Let's kick it off with what's happening with dollar yen. Have we reintroduced some real two-way risk into this currency pair that would benefit Japanese officials?
Well, I think that it had, but over the weekend, Treasury Secretary Yellen called this talk of intervention speculation, and she seemed to hint that we shouldn't expect it to be repeated. She said she expected intervention to be rarer and for the U.S. to be consulted about it. And so I think this was a sign to the market, or the market took it as a sign, that we shouldn't expect BOJ intervention today or in the near term. Markets have steadied. That is the one-way market that we were seeing, and the higher volatility has eased a bit.
So basically, are we talking about people who can reinstate some of the short positions on yen? Or are we talking about basically there's this sort of risk out there that the Japanese officials have raised that's going to keep them out of the water?
Well, I do think that the market has to respect this 160 level, maybe even 158 at the top side. So I do think that the Japanese intervention, I do think it was intervention, though we won't get it confirmed really until the end of this month. But I do think that it was sufficient to break this one-way market that was happening and give the market fear again of intervention or of action. I don't think it's going to a BOJ rate hike, which the market doesn't expect till September, October, will really be sufficient. Look what's happened since the BOJ raised rates, call it 10 basis points. The U.S. 2-year yield is up about 40 basis points.
Well, this raises this question about whether Japan's sniffing out something that's going on in the U.S., maybe not necessarily the end of its exceptionalism, but that other areas are exceptional too, and that you're going to start to see the dollar kind of weaken on some sort of maybe unsteady but direct trajectory to a different place. Do you think that that's a correct way of characterizing it, that we've sort of seen peak dollar for the cycle?
Well, I think so, but I'm not 100% sure yet. But I think you're right, Lisa, that what made the intervention in October 2022 so successful was that the Japanese uncannily picked a top-2 U.S. yield. And now we've seen a batch of softer than expected U.S. economic data, not just the jobs data, but that service ISM. And then when we look forward, this is going to be a quiet week for U.S. data, but next week we get both CPI and retail sales. and both of those look to be a little softer. So I would think of it more like this. The Japanese, again, have likely picked a top to U.S. interest rates, and therefore also maybe a near-term top to the greenback.
So, Mark, let's build on that just a little bit. You mentioned US CPI last week. A big factor, or rather next week, a big factor of last week was this asymmetric risk that so many people in the market were talking about, this idea that we're more sensitive to downside surprises than we are to upside surprises. Given the repricing we've seen in this bond market with the 10-year back down to 450 on Friday, how are we set up going into next week?
Well, we've got to get through this week first, of course. But I do think that with the combination of softer CPI, softer retail sales, that this could put a cap on the U.S. yield. You know, what surprises me is the market came away from the FOMC meeting last week thinking that Powell sounded dovish because he didn't endorse a rate hike. And now, after the jobs data, after the service ISM, the market now is pricing in 2 rate cuts over the course of the remainder of the year.
Mark, let's talk about the swings we're seeing at the front end of the curve. They're major, massive. Post-ECI last Tuesday, we were through 5% and talking about the potential for rate hikes going into a Federal Reserve decision that didn't discuss it at all based on that news conference. By Friday, post-NFP, we dropped as low as 470. Mohammed was on the program, Mohammed El Erin, we talked about it with him. We were trying to work out whether this is a feature or a bug of Fed communication. Which one is it?
Yeah, I don't know. I think that the market works itself up into a ladder on its own. You know, and think about what happened in December. The Federal Reserve said they would likely cut rates 3 times this year. And the market, by the middle of January, was pricing in 6 cuts. I don't think that can all be blamed on the Federal Reserve and communication.
Right now, I'm focused on the idea that we're at 5% for base market rates and what that's doing for a lot of investors. Over the weekend, we heard from Warren Buffett. He talked about how he has $189 billion in cash and that it's fair to see it go to $200 billion, excuse me, I'm even losing my denominators, by the end of the quarter, and that there really just aren't the opportunities to put it anywhere. But get this, he earned almost $2 billion of interest on that because of where rates are. At what point is this basically an asset class in and of itself that makes cash for companies more attractive, that really does change the dynamic in a more structural way?
Yeah, I think you're right, Lisa. I think that this is one thing that I don't think the market fully appreciates, and that is typically we think about companies being net borrowers of capital, but instead, looking at the large S&P 500 companies, they're net savers, offsetting the government debt savings. And so, yeah, I think that companies have done well in this higher interest rate environment, and we're talking about record profits, even though, you know, which is really surprising just given the so-called input squeeze from inflation. So U.S. corporates are doing very well, and they are net savers, meaning that they're net receivers of interest rates. I think that the market is still seeing the bill market and money market as a place to sort of stack capital. But I'm not sure as an asset class that it's really the alternative. I think that what happens, I think, when Warren Buffett holds on to bills or holds on to his cash, that it tends to, in the past, be a prelude to a sell-off in the stock market. And I think that when the stock market sells off, this money on the sidelines will come back in, or at least a good chunk of it.
Mark, hasn't Warren Buffett been holding too much cash for a long time now?
Too much cash? I don't know. You know, I was looking at a study of 70 years of stock market performance and how many stocks that the U.S. bill market has outperformed by. So I'm not so sure that this is too much cash. I know that people like myself, for the first time, buying some fixed income and taking our money out of the banks, which are paying us hardly any interest rate, and buying T-bills or money market instruments.
And Mark, this was great to catch up. It's been too long. Mark Chandler there of Bannockburn on this FX market and what it would take just at the end there to unlock some of that cash in money market funds. Let's talk about the data we've had. Payrolls on Friday, 175,000. So that was the smallest gain in about 6 months. That's the headline number. Take wages, slowest pace of growth in nearly 3 years. Go to the ISM services that came out a little bit later. I think a few of us were distracted by payrolls, but ISM services really disappointed. The sector unexpectedly contracted in April for the first time since 2022. You go through the details, a gauge of business activity, 4-year low, measure of input costs moving in the wrong direction. Friday wasn't a great day for economic data.
And I don't want to say the S word, stag.
Well, some people did after that number.
Well, sure, except that at the same time, Jay Powell very clearly said, I don't see stag and I don't see inflation. So stop kidding yourselves. But there was that feeling of slowing growth with sticky inflation, which is a pretty toxic recipe. We did get data out of the Eurozone, though, that actually had more optimism, which raises this question that you've been asking since the beginning of the show. How much do we start to bank on the idea of the U.S. being less exceptional? And how are we closing the gap? Is it the U.S. actually decelerating, or is it the rest of the world accelerating, or is it more likely some combination of the two?
Is something getting better, or is something getting worse? And at the moment, it feels like a combination of the two.
Yeah.
If you look at Europe, it's kind of getting better from a low bar, but only incrementally. Look at America. Yes, the surprise index has turned negative, but it's hard to say 175,000 jobs to the U.S. economy in absolute terms is terrible.
Yeah, well, you know, I'm really struggling with the data. You know this. I found it very confusing. It's very hard to come up with a narrative, which is the reason why we've got narrative roulette. Lori Calvasina has been absolutely brilliant on this, of RBC Capital, where she's been tracking just the companies and corporate earnings. And what she found was the sizable gap between earnings per share versus revenues. Earnings per share have been coming in much higher than revenues. Highlights how this is cost management. This is a very different type of environment where you could see stocks actually continue to perform well, but it doesn't necessarily bode well for the rest of the economy in terms of how thrifty these companies might have to be.
More on that a little bit later. Equity futures right now on the S&P positive here by 1/3%. In just a moment, we'll catch up with Greg Valliere of AGF Investments with rising tension in the Middle East. That conversation up next.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Good morning to you all. Getting your week started with equity futures positive by 1/3 on the S&P 500. Equities up on the Nasdaq by 1/3 on the Russell. The small caps up by 0.75%. If you switch up the board and turn to the bond market, Treasury should start trading in the next hour or so. We're looking at bunds. Yield to lower by 5 basis points on a German 10-year at 2.44. Bit at the front end as well. We're down by about 3 basis points to 2.89. If you turn to foreign exchange, lots to talk about in the FX market. Dollar yen just short of 154 at 153.74. Last week was a big week for dollar yen. Biggest weekly decline going back to 2022. Janet Yellen, the Treasury Secretary, was talking about this over the weekend. Hardly a ringing endorsement of intervention in foreign exchange, was it?
She basically said, I'm not going to comment on whether or not they did intervene, but I think that's a rumor. That said, we would expect these interventions to be rare and consultation to take place. That is a very interesting line when I'm sure that Japan would like consultation on the data ahead of time, consultation on whether the Fed's going to cut rates, consultation on a whole host of things, because they probably feel like the U.S. currency market and economy has been, switching around everything that they have. So I don't know, it's a little rich.
Yeah, I think the problem here is the communication coming from the U.S. side, I imagine, would be hike interest rates if you're so worried about the FX market. Hike interest rates. And there's a decent argument to say maybe they should.
And I would argue that probably would be the right response. There's been so much sort of fraught diplomacy, I should say, between the U.S. and Japan that everything seems a little bit more kind of heightened in terms of tensions between these two. I will say, what's Janet Yellen supposed to say? I mean, at the end of the day,
not much.
No, I mean, there's no winning either way. What was that line that we heard about Jay Powell? I think that you can apply it to Janet Yellen. Every time she opens her mouth, she has only what to lose.
Was that Claudia Sahm?
Claudia Sahm.
He shouldn't speak.
Yeah. He did his best to not speak, but he still evidently gave a dovish message.
He did do a pretty decent job at not saying much at all, which was in itself a message to this market because he didn't talk about interest rate hikes.
And we knew that, by the way. We knew that if he didn't say anything, that this market, which is looking for something to work with, anything that would go off of the nothing.
At 153.75 on dollar yen. Under surveillance this morning, Fed speak picking back up this week. We'll hear from Presidents Barkin and Williams later on today. Traders looking for clues about the Fed's path forward. Friday's softer than expected payrolls report, driving a conversation back towards maybe rate cuts this summer. We knew it would only take one downside surprise to encourage that conversation.
You know, honestly, if they did that, though, if they talked about potentially cutting rates this summer, I'd be very curious to see what happens with the bond auctions this week. I mean, I'm maybe curious anyway. I think that they're very interesting. But part of the reason why is at what point does the long end really start to sell off if the Fed shows a willingness to cut rates on just 1 week or print? We still haven't established what's going on with inflation and why it's been as sticky as it has. People thought that savings were going to run out from consumers, and they did, and then they kept spending. So people are trying to sort of wrap their heads around the unknown at a time where the Fed clearly has a dovish tilt.
What's your impression of things? Do you think that Chairman Powell's view is the view, the consensus view on the committee, or towards the dovish end of the spectrum?
My guess is he's on the dovish end of the spectrum. There is a deep fear about the fact that you do see delinquencies going up as much as they are, the fact that you did have such incredible gains in the labor market, particularly for low-income workers, and they don't want to lose those. And there's a big fear that the longer that they keep rates high, they could lose those gains, and that could be a real problem next time around. That's a different type of policy than the dual mandate of inflation and a labor market in its totality. It becomes a very tricky dance, but I think that all of the Fed officials are kind of working with this uncomfortable feeling of an uneven recovery.
We'll hear from a ton of Fed officials through this week. New York Fed President John Williams, as we say, speaking a little bit later this afternoon. Big trip for Chinese President Xi Jinping, beginning his European tour in France. He's seeking to stabilize China's relationship with Europe as the EU forges a more unified voice with the US in opposing China's capacity for cheap exports and perceived national security risks as well. You'll all remember a visit from Macron, I think it was last spring, to China, coming back talking about having a different perspective to the United States on these issues, having our own perspective in Europe and not just following whatever President Biden has to say.
Basically, we want to buy your goods, so come on over. How much is this also as part of the pressure in the Euro region of the fact that they want to get inflation under control and they will accept cheap goods from China and say thank you, unlike some people in the U.S. who will not say thank you anymore because it's no longer a gift of lower prices. We've seen this kind of motley approach in Europe. Each country has a very different approach. And how much is China trying to exploit that right now? I mean, that's what we hear from a lot of people, that they want to exploit those divisions.
There are some luxury firms in Europe that are probably very worried about that relationship going forward from here. Let's just put it that way. LVMH. companies like that. Tensions rising in the Middle East. Let's talk about those tensions. Israel's military telling civilians to move out of parts of the Gaza city of Rafah as ceasefire talks stall. The main sticking point, Hamas insists that any truce agreed upon becomes permanent. Greg Valliere of AGF Investments writing, quote, "The war will be televised with images of high civilian casualties. This will ratchet up protests in the West, including the US President Joe Biden, who gets poor grades from the public for his handling of the war, has virtually begged Israel to hold off on an invasion to no avail." Greg joins us now for more. Greg, let's talk about this, and certainly not the military response. You're not in a position to give us any perspective on that. I want to talk about the political consequences for President Biden. How great do you think they will be?
It's a really big deal, John. Just as Biden sort of righted the ship, the race looks like it's about tied. If we have another horrific round of civilian casualties and protests, even though college campuses are emptied out for the summer, there's going to be a lot of protests this summer, including in Chicago in mid-August. That's not a good story for Joe Biden politically.
Greg, those protests are hardly popular. On the one side of the screen, you've got campuses disrupted by protesters. You've got graduations disrupted as well. On the other half of the screen, there is a president pledging to do more to forgive student loans. Is that playing into the hands of the Republicans?
Absolutely. They already had quite a few issues: immigration, anxiety over the economy, urban crime. So now you add this issue, and I think the Republicans will milk it for all they can, making an argument that Joe Biden has not been able to dissuade the Israelis, and that Biden started this whole thing with his hasty exit from Afghanistan a year and a half ago.
Greg, if you were advising President Biden's campaign, what would you recommend they do? How do they message? How do they handle Israel, given the fact that this is a massive political liability for them?
It's a tough question. What they are doing is sending Antony Blinken over there to get him to try to put some pressure on Netanyahu. Even I think the Saudis are involved in a constructive way. But I think that the pressure from hardliners in Netanyahu's cabinet is going to make it really difficult to get any kind of a breakthrough.
There have been a number of polls that have come out over the past couple of days, including some that show Joe Biden losing a lot of support among the under 30 cohort. How much of that do you think is due to the conflict that we're seeing in between Israel and Gaza? And how much do you think that that's people who are going to go for Trump versus, say, just not vote at all?
Yeah, it's a huge element, I think, Lisa. You've got the young people leaving the Biden camp in droves. They feel he hasn't handled this well. The campus protests have hurt Biden quite a bit. So it's hard to say that he's going to do well with the three big wildcard groups: young people, African Americans, Hispanics. With all three, Biden's numbers are well down from the last election.
That said, there was a pretty fiery interview over the weekend yesterday on Face the Nation with Kristi Noem, the South Dakota governor, talking about her book, and she was speaking with Margaret Brennan. I'm wondering, do you think that that features into the debate at all, or that just basically eliminates her completely from the vice presidential running? Does it kind of add to the sort of drama around the Trump campaign?
It adds to the drama. I was a little surprised Trump said he wouldn't have a pick until July. I thought he would start teasing it tomorrow, getting everybody all excited. But no, I think Kristi Noem has virtually no chance. She's hurt herself. In addition to shooting the dog, she keeps talking about it. This is the sort of story you want to maybe not publicize all that much. So she's my wild card all along has been J.D. Vance of Ohio. They'll win Ohio, but I think Vance is so articulate. He's so good. He's on the short list. There's several others, but I think we've got a good 2 months to go before Trump makes a decision.
I heard something about commander meeting cricket. Did you see that? It's like brutal conversations. I don't know what it's about. I watched that exchange over the weekend. It was the most bizarre exchange. I still don't understand it. Did she or didn't she meet with the North Korean leader? Yes or no? How difficult is this to answer?
She said that she can't talk about where she's gone and who she's met. And then Margaret Brennan said, so it's a secret.
But it's not a secret because it's in the book.
Exactly. She said, but you haven't been to North Korea. And she said, well, I have. And she said, really? And she said, well, the demilitarized zone. And it was quite an interesting thing.
Okay.
That was, the dog aspect. She was talking, and she's like, well, it was in a chapter called, what was it? Something like,
Well, I've not
Bad
read the
Goat
book, so
or
I don't.
something.
Is there a chapter called Bad Goat? Is that what it's
I'll
called?
look up the exact thing, but it was quite remarkable.
Greg, you wanted to jump in?
Yeah, just a very old adage that always proves to be true. When you're digging a hole, stop digging.
Well, she
And
kept digging.
She's digging and digging herself into a hole, and I think she will not be on the short list later this summer for the job.
Let's finish up with the hole the president's in. I want to talk about that, Greg. I think it's been talked about over the weekend. It's right to discuss this. Much has been said about the tension in the Middle East, the amount of civilian deaths in Gaza and what it means for the president's support here in America, the protests taking place on campuses and the risks he faces in places like Michigan. And then, Greg, you look through the polls for the swing states, and Michigan is the least of his worries. In fact, Michigan versus everywhere else, he seems to be doing pretty well compared to the gap he's got between himself and the former president. Greg, what do you make of that?
Well, there's a big Arab American population, as you know, in Michigan, and that doesn't help him. I think at the end of the day, John, it comes down to the economy, how people feel about the price of things, and that's not a good story right now for Joe Biden.
Greg Valliere of AJF Investments. The economy, again and again and again, Bramo, the jobs market. I go back to that consumer confidence figure that we saw just the other week. That consumer confidence figure from the Conference Board, not good at all. Not good. We can sit here and you can have economists around the table say 175 is decent. Unemployment in and around below 4%, absolutely tremendous. When you ask consumers how they feel, not good.
Sarah Wolf of Morgan Stanley nailed it last week. And she said basically the lower tier of income earners right now have been in recession, and they've been in recession for a while. That is being reflected in some of these sentiment surveys. And you can see it in terms of just how much bills are going up, being locked out of the housing market, the fact that they can get jobs, but not significantly. They're still working several jobs. There are a lot of issues that have really been difficult.
Equity futures right now, positive by a third of 1% to kick things off for you this trading week. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. So former Starbucks CEO Howard Schultz has some thoughts for his former company. He took to LinkedIn on Sunday. He wrote that, quote, "At any company that misses badly, there must be contrition and renewed focus and discipline on the core." He went on to say that they should reinvent the app. They should do things like refocusing on customer experience. Of course, the impetus for all of this was shares plummeting last week after Starbucks had its first sales drop since 2020. Though he's no longer CEO, Schultz is still Starbucks' fifth largest shareholder. Now, the drama still has not ended in the saga of who gets to buy Paramount. This time around, it's ended exclusive negotiations with David Ellison's Skydance. Now, Paramount is evaluating the $26 billion offer from Sony and Apollo. However, a deal with Sony would likely draw regulatory scrutiny, considering it would combine two major film studios and lead to foreign ownership. Over the weekend, Warren Buffett said that Berkshire Hathaway had sold its entire Paramount stake, saying he was responsible for losing what he called quite a bit of money on the trade. And finally, Max Verstappen has lost a Grand Prix. You can see where my bias is. McLaren's Lando Norris claimed his first F1 victory this weekend in Miami. The 24-year-old started from fifth, but because of a mid-race safety car, he was able to go on to first and win with a 7.6-second gap. Verstappen did take second place, and Ferrari's Charles Leclerc came in third. That's your Bloomberg Brief. John.
Danny, thank you. Fantastic imagery over the weekend. Did you see that Lando Norris was standing with the former president yesterday? Donald Trump, taking in that win. Trump had been into the McLaren garage.
Yeah.
Apparently that's why Lando won.
Yeah, oh
because
yeah.
the former
I'm
president
sure.
attended.
Had endorsed it. Didn't they prevent him from having a massive fundraiser at this particular event? This was a big issue. Can I just say, it actually is, to Danny's point, very nice that Max Verstappen did not come in first, just simply because it introduces
something new.
Exactly, thank you.
I'm sure it wasn't missed by many, but I just love that the former president was supporting the orange car. Do you notice that?
All right.
I don't think people miss that.
Do you want to elaborate?
No, I think that speaks for itself. Equity futures positive by a third of 1%. Up next on the program, traders reviving rate cut bets.
The more jobs reports you get like this, where they're solid, but it's clearly moving back into something that looks like pre-COVID, the more confident we can be that the economy's not overheating.
We'll have that conversation on the other side, live from New York. This is Bloomberg.
Every single thing I've done It's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
Live from New York City this morning, equities up by 0.3%. Under surveillance, traders reviving rate cut bets.
We hit a bump for sure at the start of the year on the inflation front. Is that a sign that the economy's overheating, or is that a sign of some other thing? The more jobs reports you get like this, where they're solid, but it's clearly moving back into something that looks like pre-COVID, the more confident we can be that the economy's not overheating.
So here's the latest this morning. Traders ramping up bets the Fed will cut in September after a weak April payrolls report. Fed speak picking back up with Richmond Fed President Tom Barkin and New York Fed President John Williams later today. Luigi Zingales, professor at the University of Chicago Booth School, expecting divergence between the US Central Bank and its European counterpart, projecting the ECB will cut rates first and likely in June. Luigi joins us now for more. Luigi, good morning.
Good morning.
It's good to see. How wide is that gap between the American economy and the European one?
I think in the short term is big. In the long term seems to be huge. In a sense, I think that the European economy is not restarting at the level that was before, and the prospects in the long term are not that great. So I'm worried about the long-term fundamentals more than the cycle.
That hints at structural problems, and we've been talking about those in Europe for a long, long time. What are they? What are the big ones that still stand out for you?
I think that there are a lot. I think one is that they don't have a common strategy, and they don't have really development in the high-tech sector. And so I think that the future does not look so great, especially they're very dependent on China export. Germany is dependent, and the entire system is dependent. And the future prospect with China may not be as great.
So let's build on that, actually, because you talk about Germany, but right now Xi Jinping is over in France, and he's on this 5-day trip to France, Serbia, and Hungary. How much do you think Europe needs them? Needs them to bring in disinflation, needs to buy their cheap goods to get out of the hole that they're in, needs to be tethered to them in a way that might be really punitive down the line?
I think it needs absolutely to be tethered to them in the short term for sure, because there is no alternative to German exports, and Germany is the engine of the economic engine of Europe, and that engine is not traveling so fast. So the entire sort of ecosystem of Europe is slowed down by Germany, and so the pressure to sort of go along with China are very strong.
I was looking through the services and composite PMIs this morning from Europe. And one thing that struck me was this question of how much the weaker euro was helping the peripheral regions disproportionately still on an ongoing basis, because some people have booked, vacations to Europe for the summertime. I'm just wondering, do you read that kind of influence, that is part of what is behind these stronger than expected numbers?
Certainly, tourism is a big resource, especially for Southern Europe, especially for Italy. So I think that a weak euro is a boon on that front. But I think that Europe cannot live of tourism alone. And I think that they need a strong industry. They need a strong service sector, and it's not as strong as it should be. So I think that long term, that's a problem.
What is it going to look like? It begs the question, okay, we know that tourism is important to places like Italy, Spain, France, Greece. What is going to be the industry of the future? Look at how AI is playing out at the moment. America's dominating things again. We're talking about American companies dominating another big tech effort, and we're talking about Europe coming up with regulations. What are they actually going to do?
I think that's an excellent question to which I don't have an excellent answer. I think that the concern for privacy, which is legit, I think has overshadowed the ability of European companies to actually compete in the AI sector. And so I think that they put themselves in a corner, and it's difficult to find out. And the fact that Draghi is coming out with a report soon, and etc., is at least a sign that they are becoming aware that the problem exists. Whether the solution proposed are the right one remains to be seen.
How much energy do you have to really focus on Eurozone inflation and services, et cetera, at a time that's incredibly fraught right now at universities, including the University of Chicago, which has been a leader when it comes to certain free speech concepts? How much do you think that this is a problem of universities' own making?
I think that, in my view, is a problem of the governance of universities, because universities have been becoming more and more dependent on continuous donations, and they want to be completely independent from donors, and the two things are to some extent incompatible. And I think that students and faculty have been sold this illusion, because when you see the students say, we don't want our tuition dollars to go to fund Israel, they should be explained that it's the other way around, is the investment of the endowment is actually making tuition less expensive. So if I were a president, I would say, sure, do you want to have a different system where you pay more and you choose where to allocate your money? Fine, but you have to pay more. There is something that there is a trade-off that needs to be considered.
So what do you think it needs to be done going forward to inform some of these debates and conversations, especially at a time where a number of universities have agreed to rethink some of their investments? I'm thinking of Brown University, among others, in response to pressure from students.
So I think that some more transparency of where universities invest their money is good. I think that there is too much opaqueness, particularly because, there are the direct investment, but there are all the indirect investment they make through private equity, for example. They don't disclose any of that. And so if I am a donor, if I am a faculty member, if I am a student deciding where to go, why shouldn't I know how they invest their portfolio? I think that that's a legitimate thing. Now, this said, this decision, if it's made on the basis of values and not only value, if it's made on the fact that we decide, for example, to divest from private prisons because those are too whatever, must be done by a broader community. So I don't think that universities should be held hostages of some students that threaten to block commencement. I think that there should be either a referendum among students and alum and faculty, if that's what we are considering, or having some form of representation to determine what to do. I think that Northwestern, in my view, went in the right direction. It's my direct competitor, so I shouldn't say that.
I was about to say, that's pretty bold.
But I think that they let some students at least be present at some of this decision, which is some degree of transparency without conceding that the decisions should be in the hands of a few students. But in the past they've done it. In a sense, think about Colombia, the divestment from oil and from private prison, etc. So they made these steps in the past. So what's different now?
Luigi, just quickly, how long have you been teaching in this country?
32 years, I'm sorry to report.
And how much do you think the student body has actually changed over those last 3 decades? The big criticism we might hear is that these students struggle with wrestling with ideas, that they're soft, they don't have resilience, they can't tolerate someone with an opposing view of theirs. Is that something you've sensed on campus over 3 decades? Have you witnessed that change?
I think what I witness is students have become complexly more demanding. I remember that when I joined the University of Chicago, there was an old faculty member that says students are not customer, they are patient. And this doesn't sound like a joke anymore because patients have become customers. So I think that there's been that shift. This said, I think the quality of my students have gone up over the years because Chicago has attracted brighter and brighter students. So, we have been very lucky because we had a president, unfortunately passed away, but we had a great president that championed freedom of speech. So I was always free to say whatever I wanted, and the students have always tolerated what I said, and I never encountered any problems. So I think I consider myself really lucky.
Luigi, we're lucky to have you this morning. Thanks for being with us.
My pleasure.
Appreciate it. Luigi Zingales there at the University of Chicago, which has benefited from having Bremo on campus over the years.
That's actually the reason why I went. Bob Zimmer and some of the ideas around what was the, just, you need to be able to hear all viewpoints in order to go out there. This is sounding like an advertisement. I'm going to just stop right now.
Freedom of speech and not preferred speech, which is what Mark Rowan of Apollo's talked about. Yeah.
Exactly. You need to be able, the whole idea of safety when it comes to intellectual thought, you shouldn't feel safe. You should feel challenged because that's essentially what a university should be. But I'm going to get off my soapbox now. And we're going to look for bonds
Ben Sasso over the weekend addressed this. He was talking about, wrestling with ideas.
Yeah.
Not coddling people. It's not daycare, I think he said.
Here on surveillance.
Yeah. It feels like daycare sometimes,
Hey.
Used to be.
Let's move on.
Coming up, Waylay of BlackRock, Henry Trace of Vader Partners, Bloomberg's Geetha Raghunathan, Gennady Goldberg of TD Securities. That's the second hour of Bloomberg Surveillance. Next.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have 2 assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
They're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We have had something close to an immaculate disinflation.
We think that inflation will start to back again on that disinflationary trend.
I think they can absolutely cut all the way up until November.
The Fed is basically no longer willing to provide a forecast, to stick with its forecast, to give the market a clear trajectory. And so we're really forced to react and change those expectations for timing.
There is a concern that the Fed is overly data dependent. I think that may end up leading us into a Fed policy mistake.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Alongside Lisa Abramowitz, I'm Jonathan Farrow. MH back in a seat tomorrow. Equity futures right now on the S&P positive by 1/3%. The range we've seen on the bond market in the space of a week. Think about how much this conversation has changed. So last Tuesday, we had the employment cost index coming in just a little bit hotter than expected. We had two-year yields absolutely flying back through 5% at the front end of the curve, and a conversation going into Chairman Powell. How would he answer questions about the potential for rate hikes? Fast forward to Friday, two-year yields back down to the 470s following a softer than expected payrolls report, and the conversation completely changes. All of a sudden, after one small downside surprise on payrolls, we reintroduce the question of the summer. Are they going to cut rates?
It really depends on what kind of data they get and whether it confirms what they're going to say. We get a slew of Fed speak this week. You're going to go through all of that. We're going to speak about it throughout the day ahead. But here's the question. How much can they really have any kind of credibility if they come out saying, yeah, actually, now we're going to cut rates in July, after pushing back aggressively and only getting a couple weaker than expected prints? And oh yeah, that services data on Friday was pretty negative for them.
It was weak, right?
It was weak on the headline number and inflationary. I don't want to call it anything that has anything to rhyme with inflationary, but I do think that there is this concern about what this says.
Wagflation. That's what you just said.
I don't know. I mean,
Come up with better words, Bremo.
I'll try.
James Aberdeen of Athi talked about narrative ping pong, narrative table tennis. That was last year. That game is still going on, just back and forth, back and forth, back and forth. And I think that Peter Chia of Academy asked the right question. How quickly can things turn from being too hot to being too cold? And I do wonder how quickly that conversation can change. And I keep going back to what Mohamed El-Erian said on the program just last Friday following payrolls. Whether it is a feature or a bug, that expectations are switching from one way to the other so quickly off the back of just a few data points.
Mohamed El-Erian would say it was a bug, not a feature, and that it should be a bug and not a feature, because ultimately it creates instability and something could break. If you take a look at a number of volatility metrics, they have not shown themselves to be particularly high, but what you do see is a complete lack of conviction by investors, which is the reason why people looking for an edge are swinging violently from one side to another. I have to say, people are buying the bond market at a time when, yeah, there's a concern about default, there's a concern about inflation, but here's a story that just crossed. At $2 million per minute, Treasuries mint cash like never before. Warren Buffett talking about his almost $200 billion cash pile, generating $2 billion in interest revenue in just a short period of time. You start talking about these numbers, and suddenly people look for excuses to buy, even if you have all of the nagsters on the side raising concerns.
The nagsters. The nagging continues. Right now, equity futures, I don't know what they are. Equity futures on the S&P 500
it's Monday.
Look like this. Don't worry, just, I'm making it up with you. At the moment, equity futures are positive by about 1/3%. Treasury yields are lower again by 3 basis points. It's a break of 450 at 447.52. It is a holiday, a national holiday in the UK. in parts of, I think, Japan as well, so parts of Asia. So I think liquidity and volume a little bit lighter earlier on this morning, but as it picks up again, it's pretty obvious. It's some follow-through, Lisa, from Friday.
And why not, right? I mean, basically, the asymmetric risk really does come through most of all, which is that the Fed took the prospect of any kind of rate hike off the table at a time where companies are still doing pretty well. I was looking at a number of compilations over the weekend, summing up the earnings season, which is almost over. We're most of the way through. It's been really good. It hasn't been gangbusters. This isn't companies able to pass along price increases dramatically, but you've seen earnings beats more often than not, and that really is giving people a sense that even if you have all of these concerns out there that have been percolating for the past 5 years, you could still say, okay, maybe we can feel comfortable.
Couple of days for you. May 22nd, if you're interested in earnings, NVIDIA. Then, of course, I think it's May 15th, CPI. About a week away, so look out for that as well. Coming up this hour, BlackRock's Wei Li on what's pushing her to overweight US equities. Henrietta Trays of Veda Partners as protests continue on college campuses. And Gennady Goldberg of TD Securities on why it's been a, quote, highly frustrating year in fixed income. We begin with our top story. US equities coming off the back of 2 weeks of gains on renewed optimism for Fed rate cuts. Wei Li of BlackRock writing this. Our macro view has us neutral at the benchmark level, but the AI theme and its potential to generate alpha push us to be overweight overall. I'm pleased to say that back in New York is Wei Li. Wei, good morning to you.
Good morning.
What does Friday change for you and the team, if anything at all?
What we have seen last week was pretty remarkable. The Fed embraced high for longer. Markets priced in for high for longer, and the Fed endorsed that essentially, and markets didn't blink, right? So this wildly swinging narrative, I would say, is a feature of this new macro regime of elevated macro uncertainty, where cyclical forces are interacting with structural forces in very unpredictable ways. So having repriced number of rate cuts from 7 at the beginning of the year to 1 early last week, I guess it's not a surprise that on one weaker print on the payroll, markets then jump to the other side. But what is really remarkable is that the Fed endorsed high for longer, but markets are holding up against broadly supportive earnings backdrop. And on top of that, there is still room for repricing to take place, which is why we're overweight US equities.
Does this mean you need to be hyper tactical, or does it mean that you need to cling to different themes, get away from the cycle and focus on the structural forces?
I think it means both. I think given the very wildly swinging narrative that we're seeing in markets, there is room to generate additional alpha by leaning against some of those extreme moves. And on top of that, we have seen how mega forces like AI, how mega forces like aging population, healthcare have been generating additional kind of return on top of what the cyclical elements would suggest, which is why increasingly we're baking in mega forces in our portfolio construction, both tactically and strategically.
Let's dig into that. A lot of people have been talking about how if you want to own AI, don't own Meta, don't own Microsoft and Google, but own some of the other industries that are going to benefit from productivity gains more significantly as they deploy some of these tools. Which industries are you targeting to see the greatest benefit the soonest as a way to play this in an area that's less rich maybe than what we're seeing in some of the big tech?
We still like the big tech. They have delivered on the earnings front. They are now doing buybacks, which is well received by markets. But on top of that, we're broadening out in terms of how we're playing AI. If you look at the infrastructure, computing capacity built in AI, we're talking about unprecedented historic levels, right? So inevitably, that's going to generate opportunities for both public market and private market. But to your point about other sectors that can benefit from AI, we identified industrials, we identified materials to support the infrastructure build. We also like healthcare that has very clear use cases of leveraging AI, as well as financials, thinking about financial innovation and disruption. So there are signs of AI theme broadening out, both in the earnings report and also in the performance. And this is why we like AI as a whole, but we're also seeing that it's benefiting the broader market. market.
You like the United States more than the rest of the world still, which is interesting at a time when some people are talking about the broadening out. And I'm not talking about Japan. I know you like Japan as well. But there's a question about Europe. And Peter Scheer put it well, where he said, I like my exceptionalism to be exceptional. Are you seeing any signs that Europe is catching up to the U.S. or the U.S. is weakening just enough to come down to Europe? Are you seeing this sort of sign that maybe we're starting to shift just a little bit in terms of the exceptional narrative?
Yes, we still like U.S. better than the other part of developed markets, except for Japan, where we still keep our strong overweight. But Europe is in an interesting place. ECB may go first than the Fed in terms of starting the rate cut, but how far they will go actually depends on the Fed. So yes, there is a bit of a divergence in terms of starting point, but the magnitude, we're not expecting significant divergence. And growth dynamics in Europe is just weaker than in the US. So maybe tactically there can be some sort of relative value rebound because European equities offer better value compared to US equities and also compared to itself pre-pandemic. But over the slightly longer term horizon, we still like US for the more appropriate sector composition, better growth outlook as well.
You mentioned Japan. Let's talk about Japan. This time last week, it was 160 on dollar yen. We're back down to about 153. Lisa was asking the question quite rightly how close we were to a currency crisis in somewhere like Japan. What is there to like about Japan, and how do you navigate those very choppy waters in FX?
It's hard. That's the short of it. If you look at Japan Nikkei performance so far year to date, it's up 15%. It's outperformed most of developed market equities. Currency, of course, has added wild volatility in terms of the performance in dollar terms, but we do see that currency intervention as a real kind of, I mean, it's probably been happening, let's put it that way, which is why 160 as a floor for yen may well hold, because this is really at levels last seen over 30 years ago. Now, having said that, we're not expecting significant appreciation of the yen from here, because the real rate differential still exists in a meaningful way between the US and Japan, and we're not expecting the Bank of Japan embarking on an aggressively tightening cycle. It's just normalizing its policy from negative interest rate environment. So maybe flawed at this point, but it's really hard to be very tactical around it.
How independent is your long call on Japanese equities from this conversation in FX? The BOJ, the Ministry of Finance, how independent is it of those themes?
Well, Japan's equity performance in the latest kind of leg up has been mostly driven by micro developments. We're talking about earnings continuing to deliver. We're talking about that also benefiting from kind of inflation dynamics, earnings being nominal. And we're also talking about corporate reforms, right? You think about all these incentive schemes that the Tokyo Stock Exchange put in place to encourage companies to deploy their cash more effectively, especially those that is falling below the price to book ratio of 1 times. We're talking about 40% of the index looking to kind of get off that list. So micro development is likely going to take over from macro development as the next driver of Japanese equity upside, which is why we still like it. And having it on a currency on hedge basis gives it a little bit of an auto hedging quality, because currency is negatively correlated with the equity market in Japan. So yes, it's very volatile, but it helps offset some of that volatility if you look at it from a currency unhedged basis.
I love your idea of mega trends, just all the way around. And I'm wondering if one mega trend is going to be gold. I mean, I have to go. If we're staying in Asia, there was an article in the New York Times over the weekend about not only are the Chinese authorities buying gold, but also Chinese consumers are increasingly buying gold. And this is leading to more speculation to buy even more gold. Do you lean into that? Do you think that there's more to go as more people sort of, I don't know, whether it's valid or not, jump on the gold bandwagon?
Well, for gold, it's really hard to think about what the right portfolio allocation should be from a traditional portfolio construction perspective, because there's no cash flow. How do you discount future cash flow in a proper portfolio construction, capital market assumption framework? So it's hard. Now, having said that, it is correlated with real rate. So that's one driver of how you can think about gold forecasting. And on top of that, supply demand, right? It's not just the Chinese central bank that is buying gold. central banks across the world have been buying gold to think about diversifying their reserve. So if you look at how recently gold has been hitting all-time high, and in fact being one of the few diversifiers that were working in the middle of geopolitical escalation, it does make sense to own some gold in overall portfolio, especially as traditional diversifiers like duration haven't been acting as effectively as they used to in the context of higher inflation for longer. So the case for gold in a portfolio in that sense has become stronger.
Weili, it's good to see you. It's always good to catch up. Thank you. Weili of BlackRock there. Gold is up by 0.8% on a session, up by more than 12% on the year so far. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. As you've been discussing, Berkshire Hathaway's cash pile has hit a record $189 billion at the end of the first quarter. Warren Buffett, in lamenting the lack of deal opportunities, said that it's a fair assumption that it'll hit $200 billion at the end of the quarter as it continues to mint interest income. He also tried to caveat his sale of Apple shares. Now, despite selling about $40 billion, he said that Apple is one of the best company he owns and will continue to be its largest holding. He then went on to imply that the sale was motivated by tax implications. Now, it's been years of delays, but now Boeing's Starliner space taxi is set to launch humans into orbit. The Starliner's inaugural flight will take 2 astronauts into the International Space Station. It will be key to prove that Boeing can transport humans safely to space. But with confidence issues over its aircrafts, Boeing faces questions about the long-term vision for its space business. And baseball's biggest star is not slowing down. Shohei Ohtani went 4 for 4 at the plate on Sunday, including 2 home runs. He powered the Dodgers to sweep over the Atlanta Braves in a 3-game series. Now, one of those home runs traveled 464 feet, which is his longest of the season and close to the longest he's ever done. It was Ohtani's first multi-homer game with the Dodgers and the 17th of his career. It means he is now tied for Major League long balls with 10 so far this season. That's your Bloomberg Brief. John.
Amazing. Absolute beast. Danny, thank you. Up next on the program, calling for discipline on campus.
You can't be shouting globalize the intifada or Zionists don't deserve to live. I'm proud of a lot of the young people who want to end the war, but they need to show the discipline.
We'll talk about that lack of discipline up next on the program, live from New York this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
2 weeks of gains on the S&P 500. Equities adding to that this morning, up a third of 1% on the S&P. Yields a little bit lower again. We're down 3 basis points on a 10-year. Remember all that chat about retesting 5%? It's a break of 450 this morning on a 10-year maturity, back down to 447.92. Under surveillance this morning, calling for discipline on campus.
We have to understand that this is a defining moment for this generation, similar to anti-Vietnam protests, anti-apartheid protests. You can't be shouting globalize the intifada or Zionists don't deserve to live. What's being lost is that those few protesters who are inciting violence or engaging in that kind of anti-Semitism are diminishing the thousands of young people who simply want the war to end. I'm proud of a lot of the young people who want to end the war, but they need to show the discipline.
So here's the latest. Police arresting 25 people for trespassing at a pro-Palestinian protest at the University of Virginia as unrest continues on college campuses across the nation. Henrietta Trey's of Vader Partners writing this. Many think recent public unrest will help Republicans in November, a view that is plainly shared by Republicans in Congress who are drawing attention to the protests with publicized visits and on-campus events. Henrietta joins us now for more. Henrietta, let's talk about what's happening in the Middle East and what it consequentially could mean for the President of the United States. Much has been said about Michigan, and yet it's interesting, and I know lots of people wrote about this over the weekend, and we talked about it earlier on the program. Michigan is one of the swing states that the President is doing better in relative to all the others. So what do you think is really driving the polls at the moment?
Right. I think that if you look at the polls, this is a minute issue area. It's just one that's being popularized because the press clips are so available. You got viral video feed. And these are really elite institutions across the U.S. You're talking about UVA, a tremendous school, Harvard, Yale. This is not your run-of-the-mill college experience. And these elite Ivy institutions are already polarized within the United States. In fact, if you look at data going back through history, but most precipitously since 2016, Republicans, specifically Republican views of K through 12, college education, and unions drop off a cliff. So this is a basket or an issue area that a basket of voters are already predisposed to view negatively, and so it's being exacerbated. But to your point, in states like Michigan, where Biden continues to poll better than any other swing states, this is a huge educated population, substantially large college education, and this is not moving the needle the way that you would expect to see if it was a major defining issue. As your last segment said, 25 students is not the same as the 1960s with the protests against Vietnam. Further, I think that the students are suffering from mission creep, as Bloomberg noted last week. And as they go home for the summer holiday, this will sort of dissipate.
You're expecting that after the summer, this won't be an issue anymore?
Well, I think that the Biden administration is working assiduously on getting a deal with Saudi Arabia that would require relations with Israel and would also, according to reports, require that Israel wind down this war. So I think that there are efforts that are happening right now and could reportedly be announced within the next couple of weeks that are designed to end this. So things could escalate now, but kids are already taking their final tests and are about to go home. When they come back, as Lisa just pointed out, I mean, parents are going to say, look, I'm paying a lot of money for you to go to these fancy schools. Go to school, go to class.
Yeah, that was the Saturday Night Live sketch over the weekend, right? Basically, if I find out my daughter's in a tent when I'm paying for a dorm room, I'm going to have words. There's a question, Henrietta, though. You had confidence that there was going to be some sort of resolution, even though over the weekend we saw discussions break down between Israel and Hamas, and the delegations leave Egypt. What gives you confidence that there are other deals in the works that could potentially draw an end to the conflict?
I think that global sentiment and pressure around Israel is at a level we've never seen before, literally since its creation. I think Majority Leader Chuck Schumer and the Democratic delegation in the House and the Senate is acting in a materially different way than we've ever seen before. And pressure from the Biden administration, whether it's in terms of sending munitions or not, or predicating aid on certain types of behavior, is really morphed versus what we've ever seen in the past. Again, it's early May. We've got a long time to go. And I think popular support for this is rapidly declining in new and novel ways that sort of require.
This has been very much driving the headlines recently, everything that's going on with the protests and, of course, the conflict itself. And sort of the slight side story here is whether Speaker Johnson's going to hold on to his role. We heard more discussion. There's going to be a vote this week on that. I'm wondering, given some of the polarization that you're just talking about, do you think that it's feasible for Democrats to bail Johnson out?
I think it is feasible. I'm really impressed by Minority Leader Jeffries' ability to say to the caucus, hey, I understand that this is unprecedented, but I want everybody to vote to table the motion. And the conference effectively goes along with him. That's what you want to see in a post-Pelosi leader. And that's what they've demonstrated already. And he's been able to generate wins for his caucus, which is why they're able to follow him on this difficult vote with relative ease. So I wouldn't be surprised if Marjorie Taylor Greene puts this deal up, and the motion to table is what I understand will come up for a vote first. That will pass. There will not be a formal motion to vacate the speaker. And even if they did move forward with the motion to vacate, there is no replacement for Johnson. I think that needs to be appreciated by everyone here. There's no alternative. So as long as there's no alternative, there's no real external pressure point. You know, we're not facing a government shutdown or anything like that. You're not going to oust the speaker at this juncture.
For now, they're managing to play nice. Henrietta, down in Washington, D.C., there is this question, ongoing question about the future of democracy. The President of the United States wants to make this an election issue. Do you think it is one?
It definitely is one in all the polls consistently, and Biden polls much better there than former President Trump. This election is really going to come down to two baskets of demographics: independent women, who are currently 7% undecided, and double haters, people who think that both Biden and Trump should not be on the ticket. There's about 8% of the population that makes up that basket. And they are, in most polls, going 2-for-1 for Biden. And the issue of democracy trumps everything else. The issue of the economy is always up there, but I've said, and I've said this to clients as well, I think it's sort of a useless measure. People are feeling inflation. They hate the economy. I don't know if people have ever really loved the economy generally. And so what you see are other issues taking hold, whether that's going to be immigration and crime or abortion, or really this amorphous idea of like protecting democracy, where Joe Biden wins by double digits. So that's really the ball game. And again, with independent women and double haters.
Henrietta, thank you. Henrietta Trace there at Vader Partners, breaking down the issues down in Washington, D.C. Did the double haters turn up or stay home? That's what I want to try and get my hands around going into November.
The fear is that they stay home, right? Or what are they going to vote for when they get there? If they're just like, I hate this, are they going to vote for the third party candidate, which is raising this question of where do you divert more votes from in terms of that Kennedy run? Do you divert it from Trump or Biden?
Yeah, this is why you keep hearing the sitting president, talk about this issue, the future of democracy. There is a belief. Henrietta just gave you the framework there that, sure, it might not be influencing the polls right now, but as you get closer to November, those people that haven't decided yet, they'll lean Biden over Trump on that issue.
We've got 6 more months of this. Yesterday was 6 months exactly. It was the anniversary, the pre-anniversary.
It's going to take a while.
It's going to be fun.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Hey, the rally continues. We're up another third of 1% on the S&P. On the Nasdaq, we're up by 0.25. On the Russell, the small caps up by 0.8. Attempted to make May better than April because April was absolutely brutal for the small caps. Coming off 2 weeks of gains on the S&P, the longest weekly winning streak going back to March. April was pretty choppy. If you switch at the board and go to the bond market, we can check out treasuries now. 2-year, 10-year, 30-year, yields lower by a couple more basis points. We're down in the 440s on a 10-year. Down 2 or 3 basis points, 447.92. Lisa, not excited about the week ahead, with the exception of maybe one thing, which is some supply. So let's talk about it.
Exactly.
$58 billion of 3-year notes coming tomorrow. After that, $42 billion of 10-year notes. Then you get some 30-year bonds, $25 billion worth, and we've rallied hard into that issuance.
So I want to see the internals of these, basically the idea of how well these go, given the fact that recent longer duration bond sales have not gone as well. There is a feeling that right now the Treasury Department is moving around some things so that they can fund things on the front end and not really pressure the long end so much. Is the renewed enthusiasm around rate cuts really driving people to lock in duration, lock in those longer term yields for the longer period of time? I don't know the answer to that. I will find these auctions incredibly interesting this week.
I'm sure you will. Can we go back to the bond board? Can you just bring up the 2-year again? I'd like to look at that just for a moment. So the 2-year at the moment looks like this, 479.50. On Friday at the lows, we trade as low as 470. Could have broken into the 460s. Think about where we went on the week. So the low was 470.77. Okay, that was post payrolls on Friday. The high was 5.04% on Tuesday post ECI. And the question we've asked so far this morning, is that a feature or a bug of Federal Reserve communication? Now, Mohamed Al-Arian said it's a bug. Then you heard from Wei Li, she said it was a feature.
Basically, this is what we're talking about, a complicated cross current of lots of different drivers, and you're seeing that borne out in the data, and traders are responding to that. It hasn't broken anything yet. That is what a lot of people have argued. Although there was another bank failure, Republic First, what is it about these names? It was First Republic and then Republic First. Is it something like some order of those names and then you fail? But there's a question of, well, what's next? The slews that we get out later today, remember when that used to matter?
That was the thing last year, yeah.
Now we get them again. At what point do we start to see some of the fissures, or have we completely moved past that to give people the sense we're out of the woods, the Fed can cut, and everything can go on?
There is an impression over the last 12 months that we have moved past that, but to your point, we'll see. Let's turn to foreign exchange. Dollar yen this time last week, 160.17 at the high. Unreal where we were on Monday, then all the way back down to 152 as early as this morning, back to about 153.78 at the moment. So just another massive range today on dollar yen, Lisa. Looking at the range right now, the low was 152.78, the high was 154. So again, all over the place.
I love that you frame this, though, within the rubric of, is this a feature or a bug? This incredible uncertainty of what the new level is for the Japanese authorities to come in. They like uncertainty. They want to leave people guessing, and they intervened in certain, or suspected to intervene. We'll find the numbers officially later this month. But, at a time of low liquidity. So you have to wonder how much they were just trying to basically slap around the people who are trying to short them and speculate so that they didn't get back in. Are they getting back in now? I mean, these are really compelling movements, but I also think it's a holiday in Japan. So
we certainly reintroduced some two-way risk last week. Let's put it that way. And they can thank the United States for some of that. The news conference with Chairman Powell, the incoming information, and getting involved themselves. To your point, just slapping things around a little bit, reintroduce that volatility. Steve Englander of Standard Chartered last week, just brilliant on that if you want to check out that interview. That's the story in foreign exchange. Under surveillance this morning, plenty of Fed speak, picking back up today. Presidents Barkin and Williams on deck. Traders paying close attention after a softer than expected jobs print. Renewed optimism that the Fed would cut rates this year. Look out for Williams this afternoon. Elsewhere, Israel's military moving citizens out of Rafah, a possible precursor to a long-expected attack on the Gazan city. It comes as ceasefire talks appear to have stalled, with Hamas insisting that any truce, Lisa, is permanent.
And this definitely is not what Bibi Netanyahu wants to see, which is the reason why he's outright rejecting it. Interesting what we heard from Henrietta Trays just moments ago, where she was saying that she still thinks that there is a deal likely to happen, just not necessarily in the same kind of way as talks between Hamas and Israel, but probably more as part of some sort of deal with Saudi Arabia brokered by the United States, by Qatar, by a whole host of others. I'd be curious to know whether the administration of Israel really is beholden to the pressure that she was talking about. Right now, it is unclear whether it is survival for Netanyahu, because he's politically challenged in a massive way, or whether it's actually understanding what the tensions are, what the risks are, and moving forward on that front.
It was interesting what she said about the protests going away through the summer, because you can see the campaign ads already. You can imagine them. They're pretty clear. On the one side, you have students shutting down campuses, some of them using anti-Semitic language. On the other side, you have the President of the United States talking about forgiving student loans. Then at the end, it says vote Republican. This is endorsed by the former President, Donald Trump. You can see how that works out. Basically, what she's saying as an issue, this goes away after the summer. You sure about that?
I don't know how much is being I don't understand what's driving these protests. I do understand that on universities, there has been a lot of concern, and frankly, among everybody who's seen all the images of people in Gaza who are suffering and who are losing family members. There's a question of what you do with that and how you sort of effect some sort of end to the conflict. I don't know whether it's going to morph into something else. We heard about mission creep. We don't know how much this is going to morph off of some of those college campuses. It seems like there are a lot of people who are entrenched. We heard about other actors. Reporting showed it kind of varied depending on the place in terms of other non-university students who are on campus. I don't think we have a full understanding of what was driving these protests, and until we do, to really understand the trajectory that they will take is going to be tough.
And who's influencing them? You've talked about that. Who's funding some of this stuff as well?
Yeah, well, and this has been, reporting has been percolating out. Just having students go home to their parents saying, we're paying $90,000 for you to be in university and going to the dorms every year, and you're going to be in a tent protesting and not graduating, and going remote again after starting the beginning remote, since it was during the pandemic, seems a little bit misdirected. At the same time, you have to wonder about these students. Like, they've lived through a pretty angsty moment. And so I just wonder the different, psychological questions that come out too.
Yeah, plenty of those. Let's turn to this. Shares of Paramount rising in the pre-market. The company opening negotiations with a bidding group led by Sony and Apollo, according to the New York Times. It comes after an exclusive negotiating window with the movie studio Skydance expiring on Friday night. Geetha Raghunathan of Bloomberg Intelligence joins us now for more, with that stock higher by almost 4%. Geetha, let's talk about the offer on the table from Sony and Apollo. How great is that offer? What is the opposite offer to what we've heard from Skydance?
Yeah, so definitely in terms of the financial terms of the deal, John, the offer is way better. It's $26 billion all in a cash deal. And what it basically promises to do, and this is where it kind of really differs from the Skydance deal, is it offers to treat all shareholders equally. Now, remember, with the Skydance deal, there was so much of backlash, there was so much of resistance, because while the Class A shareholders, especially Sherry Redstone, who is the controlling shareholder, kind of gets a preferred treatment, all the other shareholders, the non-voting shareholders, were really going to be treated unfairly. With Sony Apollo, we're looking at least a 50% premium to where the stock was trading on last Friday. So definitely from a financial standpoint, much, much better.
Meanwhile, people used to talk about concerns about antitrust, and that was the reason why deals can't get done. Is that a concern here at all, or is basically there's sort of been a shift in the tide with respect to concerns around antitrust, and media another subject for antitrust officials to deal with.
It definitely is a concern, Lisa. So you have two major Hollywood studios that would be combining in this transaction. You have Sony and you have Paramount. That would be about 20 to 25% of the box office. And really, it has ripple effects across the industry because this basically now reduces the number of content buyers from 5 to 4. And so it has ramifications across the whole of Hollywood in terms of demand for content. So that is definitely something that, we kind of have to keep our eyes open for. And then the other thing is with Sony being a foreign company, there is this question of whether they would be allowed to own a broadcast network. Paramount is the owner and operator of both the CBS broadcast network as well as broadcast stations. And so there's a little bit of, ambiguity there, whether they'll be allowed to do that.
Fascinating. Whether we're to hear national security again raised with potentially that acquisition. In the world of acquisitions, we do get Disney earnings after the bell today, and we've been hearing about questions. What are they going to sell? How can they raise money in other ways? And one big question's been around ABC. Overnight, ABC News' president stepped down. Do you think, or are you hearing that this is sort of a predecessor to sort of jettisoning the news outlet?
So last year, Lisa, there was a lot of back and forth. I mean, Bob Iger had said something about, getting rid of the linear networks, that it wasn't core to the Disney business. Then he kind of walked that back a little bit. I think we've seen a complete change in sentiment at Disney right now. They really have got their mojo back. They do not need to sell any assets as we see it. And if you kind of look at even at the linear TV networks, yes, this is the most challenged part of their business. There's no doubt about that. You have cord cutting, you have TV ad pressure, but it's still a cash cow for Disney. It throws off about $3.5 to $4 billion in EBITDA, even with all the pressures. And just because they have really must-have programming, they do have a lot of sports content on ABC. We do think they'll be able to hold out pretty well.
Can I just say that Shogun on Hulu was excellent? Can I just throw that out there?
You have been trying
Brilliant.
to pitch
Honest,
that.
You need to watch that.
Okay, I will. And I will eat humble pie, too, because I missed
You will love that.
Disney reports earnings tomorrow before the bell.
Sure, whatever. It doesn't matter. You will love that.
All right, I will watch it. I loved Game of Thrones, and this is another version of
better than
similar.
that.
You think so?
In my opinion, I was never a big Game of Thrones guy.
Really?
Too long. Took too long to get through.
Oh, come on.
Don't have that kind of time, Bramo.
Oh, give me a break.
Got to prep for stuff like this. Facts like this, Geetha, that the Fall Guy hardly took any money in over the weekend, even though the production cost something like $125 million. How soft is the movie slate for the theatre business in the year ahead, Geetha?
Yeah, this was a little bit of an underwhelming start to the summer. Usually you have a big bang movie, a Disney movie typically that comes out. Last year we had Guardians of the Galaxy. Yeah, definitely a little bit of a soft start, but there is a lot to come, John. So, just talking about Disney itself, we have two big things that we're kind of looking to. Inside Out 2, which comes out a little bit later. And then, of course, you have the really big one, Deadpool, which should be absolutely massive. And then we have a lot of good content from other studios, too. Right now, as we kind of look at the box office business, it's tracking about 20% lower versus pre-pandemic levels. So definitely this is not the big year of the rebound. So if you look last year, we had about $9 billion in box office. This year, we're actually tracking to about $8.2 billion. But then next year is when we're going to see, all the studios come out, all guns blazing. And a lot of this is because of those Hollywood strikes last year, which is why you kind of have a slightly lighter slate, a lighter pipeline. But yeah, summer is going to be good, but not great.
Mission Impossible next year, I think.
Oh, that's
Got to wait
totally
another year.
That's
Got to wait for that.
That's your gig. What about
Geetha, thank you.
Unfrosted? You're
Can I
going to
just
watch
say
the
thanks to
Seinfeld?
Geetha first.
Okay, go ahead.
Geetha Raghunathan of Bloomberg Intelligence, thank you so much. Tomorrow, Lisa mentioned Disney. Interview with the CFO coming up, Hugh Johnson, tomorrow at 7 a.m. Eastern time. So look out for that as well, all right?
Fabulous. Well, no, there are some interesting movies coming down the pike.
I watched The Fall Guy this weekend.
And what'd you think?
Yeah, it's really good.
Really?
Yeah, yeah.
Do you want to put a plug
Gosling, Blunt. I just did one.
Okay.
It was really good.
Okay.
I enjoyed it. It's one of those. I don't care about reviews for movies.
I know you
really
don't.
I just couldn't care less.
Really?
Yeah, you want to go and have a bit of fun. That was a fun movie to go and watch.
There's no part of you that's thinking, okay, that part of the plot didn't really hang together.
No.
Didn't really like that character.
I don't care. Gladiator 2 later this year. I'm going to watch that. I love Gladiator.
A little bit flat in terms of narrative development.
Not bothered.
Never?
Nope.
Okay.
I have my own opinion on things, Bramo, and not be shaped by the elites. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israeli officials have seized equipment from Al Jazeera on Sunday, just hours after the government decided to shut its operations in the state. Al Jazeera denounced the move, calling it a, quote, criminal act that violates human rights and access to information. Israel has claimed that their reporting echoes Hamas propaganda. The decision has led to backlash within Israel, with petitions filed to move the case to the Supreme Court. And the Credit Suisse CEO, Ora Corner, is set to leave UBS in the coming weeks. People familiar tell us Corner had hoped to leave the business sooner, but he was persuaded to stay on until after the legal merger was completed. He was the only Credit Suisse executive to gain a board seat, but he had kept a low profile during the integration. And former Starbucks CEO Howard Schultz has some stinging words for his former company. He took to LinkedIn on Sunday, writing, "Own the shortcomings without the slightest semblance of an excuse," referring to Starbucks' first sales drop since 2020 and the 16% drop in share price that followed last week. He said that they need to reinvent the app, overhaul its marketing strategy, and refocus on the customer experience. Schultz is still the 5th largest shareholder of Starbucks. And that's your brief, John.
Danny, thank you. Thank you very much. That stock has had such a difficult time. The one thing that wasn't mentioned there was the boycott.
Yeah.
What's the advice there? What do you do about that?
I hope it blows over. I mean, how much pressure? But you have to wonder how much pressure some of these executives are putting on the White House to put more pressure on Netanyahu, to put more pressure on. I mean, at what point do you
tease out what is a consumer problem with the cycle and what is a problem around boycotting and develops in the Middle East?
The reality is you can't control that. So you can control how competitive you are, what you charge for a latte, and how you draw people in. Was lavender the best way to go about it? Is pumpkin spice the best way to go about it? These are key questions.
They obviously are key questions, and they clearly don't have the pricing power at the moment. Futures are positive by a third of 1%. Up next, the case against data dependency.
This volatility, which we are continuing to see in rates, risks breaking something elsewhere.
That conversation coming up next. You keep bringing up this lavender latte.
Actually, I think AMH did that last week.
Yes, she did.
Yeah, because they have big billboards that say lavender.
You want to go try one later?
Not really.
Okay. From New York, this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Informed by the team that the latte coffee with lavender tastes like soap. Was that the review?
Well, I mean, look, we're not in the view of putting views out there that you need to listen to. Try it yourself.
I'm not saying anyone should follow those recommendations.
Well, it's kind of what you'd expect. I mean, lavender, you think of a soap you put in your drawer to make it smell good.
Okay, but not to taste.
I mean,
with coffee.
Some people like lavender.
Okay, we're saying that's why the stock is down 16% over the last month, really?
All right, let's move on.
Let's do
Evidently, that was an 11-year-old.
Equity futures up by a third of 1% on the S&P 500. Yields are lower by a couple of basis points, 448.33. Under surveillance this morning, the case against data dependency.
This volatility that we're seeing in the interest rate structure, it is causing havoc elsewhere in the world when U.S. rates swing as much as they do on a short-term basis. So this volatility, which we are continuing to see in rates, risks breaking something elsewhere.
Here's the latest. Treasury surging after the US payrolls report came in below estimates, with investors now upping their bets for Fed easing this year. Gennady Goldberg of TD Securities writing, quote, "This year has been highly frustrating for fixed income investors as markets continue to overreact to every data point. The market will continue to lurch from data point to data point, with Treasury yields likely to grind in a range for the time being." Gennady joins us around the table. Gennady, good morning.
Good morning.
Is it a feature or a bug of Federal Reserve communication to see swings like this?
This is exactly what they get when they say data dependent. I mean, if you provide no forward guidance, the market's going to over extrapolate from every single data point. And we're going to see this over the next couple of weeks. You know, you mentioned this week's relatively quiet. We'll see what happens with CPI. Let's say you get another, softer CPI print. Let's say you get a 0.2 on core CPI. All of a sudden, this market's going to over extrapolate and say maybe the economy is slowing. Maybe they will cut. Yeah, rate cuts as soon as June. Remember, a couple of months ago, we were pricing in a full rate cut by March.
Yep.
And 6.5 cuts at the peak this year. That's gone down to 1 right before, payroll. So this market's going to keep swinging around. But at the end of the day, if you zoom out, I think the valuations are quite attractive. That's what you keep hearing from investors.
Let's get into that. Further out along the curve, is that where you want to look? 450 on 10s, does that make sense?
I think the 5 to 10 year point is your sweet spot. I'm a little bit worried about going further out the curve. So I do worry that the 30-year auction this week, for example, is going to be a little bit, a little bit touchy, just because of the amount of funding the Treasury has to do over the next couple of years. I think it's very important what they said in their last week's refunding statement, the fact that they've paused auction size increases. They haven't stopped them. And they've asked us, when we fill out the surveys, they said, when do you expect us to increase them further? It's a very key point in the language where they're not stopping anytime soon, so term premium is going to have to rise. But that 5 to 10 year point, from a fundamental standpoint, makes a ton of sense at this point.
Especially if they're basically waiting for people to want to buy it to then sell it. So they're going to wait for yields to fall before they sell it and flood the market with some of the supply that they're expecting. You talk about the income and that you're looking for entry points. You're probably going to be one of the buyers on Wednesday at the 10-year auction. Congratulations. We'll be asking you about it. There's a story, I keep looking at this, at $2 million per minute, Treasuries mint cash like never before. How much is that essentially the reason why people are buying, the reason why we're going to get stability here, the reason why we're going to be in a range, not necessarily oscillating above that 5% mark?
I think Treasuries are attractive, especially on the real rate side, right? If you look at 2.25% on 5 and 10-year real rates, roughly between 2 and 2.25%, from a long-term standpoint, that's super, super attractive. And the flip side of that story, by the way, is it's $2 million a minute that we, the American taxpayers, are actually paying on the U.S. debt. And that number is only going to increase. The fascinating thing to me is the average yield on the outstanding treasuries at this point, excluding bills, is 2.6%. That's what people are getting at the moment. Now, as the longer we stay at these 5% levels, the more that's going to go up and the more that Treasury debt burden is going to increase and the more income that's going to kick off to everybody else.
Which raises a question about the long and variable lags, which a lot of people in the market say don't exist, and other people say, well, actually, that's the reason why we haven't seen the ramifications for this. Let's try to make SLUs interesting. We get them later today. No, I'm serious. And let's say that this...
Oh, I know you're serious. Yeah. No one needed that.
Well, look, you get the sense of what banks are doing when it comes to lending. If they're still lending at a pretty fast pace, if people still are borrowing, does that indicate that this rate can be closer to the neutral rate, that this might be the new reality, and that we could stay here for a very long time?
Yes, but I think the composition of the lending matters as well. I mean, what you're seeing right now is banks actually tightening lending standards. They know when rates are high, when the folks who are coming into the doors at this part of the cycle tend to be the ones who have higher credit risks. That's why they've been tightening up lending standards, because they're very careful not to overlend at this part of the cycle before things really get kind of flushed out. If you continue to see very, very strong lending, sure, maybe rates are actually appropriate here. I subscribe more to that camp that, you know, the lags are long and variable, and it's going to take more time for the stuff to filter through into the system, rather than rates are too low, and that we actually need to hike rates another, 100 or so basis points to actually get an impact. I think you're seeing it. It's just not as fast as anybody expected.
What do you think is the main channel for that restrictiveness to reach the U.S. economy?
So typically, a lot of it goes through the mortgage channel. I mean, if you look at where the biggest sources of consumer borrowing are, most of it is housing. Then you've got auto loans and credit cards. It's acting on those last two, but mortgages are basically 60–70% of, in terms of volume of the borrowing. The average rate on the U.S. mortgage is still 3.6%. That's not really going up, and the housing market's kind of in a limbo. It's stuck, right? So until that starts to filter through, and I think it does over time, slowly. It's the same deal with the 70s.
Well, can I ask you sort of what over time slowly is? Are we talking decades or months?
Not at all. I think over the next couple of, call it 6 to 12 months, it should filter through substantially into the housing market by just slowing down the levels of activity, right? If you're not moving, you're not hiring movers, if you're not getting new furniture, and it trickles through into all of this. The issue is we're coming off of extremely strong growth levels, very supportive fiscal policy. And now monetary policy has become restrictive. Fiscal is still easy. So the question is, where does that equilibrium come?
So for a while now, it's felt like sufficiently restrictive has a question mark after it. Correct. You don't think it does?
I don't think so. I think we know we are restrictive. The question in everyone's mind is just how restrictive. Are we the equivalent of unsustainably restrictive, or are we in this, to Lisa's point, are we in this neutral sweet spot where we can actually sustain this for a very long time? That's what investors are trying to grapple with. That's why everybody's trying to kind of leg into rates at this point, realizing that these are high, but they don't want to go all in here because they've been burned over the last couple of years by rising rates.
Oh, everybody's super nervous. You can feel it. You can feel there is this nervousness around going from too hot to too cool, too cold, almost just like that. You felt it on Friday afternoon. I was going through some of the Southside notes. We'll catch up with Peter Cheer, by the way, of Academy in about an hour from now. Peter was addressing this. What is the risk of flipping from questions about things being too hot to being too cold, and just like that?
Yeah, lack of conviction is not comfortable. Lack of conviction and understanding how to frame things out isn't exactly a nice place to feel, I guess I see what happens. And a lot of people come on, yeah, they might not be that interested in what the data is going to show, but they have to be glued to it because something could burn them. And that's been the sort of percolating angst this year.
CPI, about a week away. You'll get the CPI report next week. Gennady, it's good to see you. Gennady Goldberg there of TD Securities. Coming up in the next hour, we'll catch up with Keith Lerner of Truist, Ken Leon of CFRA, Citi's Veronica Clark on, what do they call it, Summer Dovin happened so fast. I mean, I love that. We're going to quote that later for you, okay?
Want to sing it.
Peter Cheer, I do not. Peter Cheer of Academy is going to join us on just how exceptional things truly are.
Yeah, he likes exceptional to be truly exceptional, and if it's not, then forget it. Can I just give you this statistic?
Please do.
Torsten Slok of Apollo. 40% of homeowners don't have a mortgage. 95% of mortgages are 30-year fixed that are not sensitive to the Fed rates. Just giving you a sense of how stuck this market really is.
Those lags, I was saying, is it decades or months?
Yeah, it's 30 years.
It's decades, apparently, in some places, but Gennady disagrees because things will start to happen. I'm not saying they won't, by the way. I know that sounded really snarky. That's not what I meant. Okay. Futures positive by a third of 1%. From New York, this is Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Very hard for me to see, given everything we know, a hard landing scenario playing out anytime soon.
The equity market has been, much more resilient to these shifts in the interest rate narrative.
You have to give markets the benefit of the doubt here, irrespective of what the data looks like.
At some point, you will have to pay the piper. Fed policy has only become really restrictive relatively recently.
This volatility, which we are continuing to see in rates, risks breaking something elsewhere.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the third hour of Bloomberg Surveillance begins right now, with equity futures positive by 1/3% and a very light calendar for the week ahead. So light that Bramo is doubling down on the importance of bond issuance through the week. We'll talk about those numbers, the Treasury supply, in just a moment. We'll talk about the data next week as well. CPI on May 15th, the last big stop for this conversation following the data we got on Friday. And this Monday morning, we still need to reflect on what we heard on Friday. Payrolls, smallest gain in 6 months. 175. Wages, slowest pace in nearly 3 years. And shortly after that payrolls report, we got the ISM Services Index, which is an important read on the US economy, contracting in April for the first time since 2022. Elisa, the data, not great.
That said, prices paid increasing at the same time. So it raises this question, what is more important right now for the Federal Reserve? Is it going to be employment? Is it going to be the strength of the economy ongoing and the hope and the dreams of a soft landing? Or is it going to be inflation front and center, given the fact that it has come down a lot, but still has a long way to go?
This would be the bearish argument. You're going to like it, okay? Some of you might like it at home as well. This is what it would sound like. Let's take the ISM on Friday. So what you can hear are companies losing pricing power, but still worried about inflation. What do you have to do if you want to protect margins? You cut costs. What's next? Is it labor? That's where you can start to make the argument that you're going to start to see layoffs And as a result, you start to see a broader slowdown too.
Which really, I mean, that potential outcome is sort of hinted at in some of the earnings compilations that are talking about the fact that earnings per share came in stronger than expected on a much more consistent basis than revenues. In other words, companies are managing their costs much better. And this is something that Lori Calvasina pointed at RBC over the weekend. This raises the question, how are they doing that? How far will they have to go if they don't have the same kind of pricing power that they've had in the past in terms of cutting staff? So far, though, this has been a story for a while, and we still haven't seen it in mass.
Well, initially we were talking about hoarding, that we were coming out of the pandemic. They struggled to hire so much that why would they fire so quickly? You wait a while. We're getting closer and closer to that moment. And based on the employment component of some of these PMIs, we could just talk about how much weight you should put on those PMIs, single month of data. We can talk about that with Citi a little bit later on the program. But ultimately, is that going to be a trend that starts to build?
Especially given the fact that we're seeing more pushback in a whole host of different consumer-facing sectors. Think about some of the airlines, particularly the domestic-leaning ones that are talking about much more cost-conscious consumers, right? So there is this feeling maybe things are slowing. But again, this is a reason why Wei Li has been so great on this, about how it's so confusing, and they're just sort of, well, what about AI, and what about this trend that comes in, and what about this, and all of a sudden materials. So if you go work on an oil rig offshore for a couple weeks, you're going to make a lot of money, and you're in demand. So all of these sort of cross currents make it pretty messy.
Yeah, easy to focus maybe, easy relatively speaking to focus on these secular themes and not get whipsawed by the cyclical stuff from day to day, given the range we saw in some of these markets just last week. So we talk about the numbers, we can do that. Let's go through the supply. I promised you this, so here it is. We'll start with a 3-year note that comes tomorrow. $58 billion worth of 3 years. The day after, here's another number for you, $42 billion of 10-year notes. And the day after that, the 30-year issue, $25 billion. We caught up with Gennady Goldberg of TD, who said he's more concerned about things further out along the curve than he is closer forward.
So this is $125 billion of debt sales. I think that he is correct to say maybe there's a little bit more concern over the very long term about what inflation and the risk premium looks like for the U.S. I'm more interested in the 10-year note, just simply because that is the benchmark rate. And so many people were saying, maybe we could retest 5%. Is that really feasible if you have a really robust demand from a domestic base, from international bases? This, to me, is a key question.
Bond yields a little bit lower this morning. We're down 2 basis points, 448.54. Tons of supply. That was just for you.
Thanks, I appreciate
Tons of supply coming this week. Coming up this hour, we'll catch up with Keith Lerner of Truist as stocks move higher post-payrolls. CFRA's Ken Leon on his downgrade of Live Nation, citing antitrust concerns. And Citi's Veronica Clark looking ahead to a parade of Fed speak. We begin with the big issue. Bad news is good news for stocks. Stocks climbing as a weak payrolls print gives investors hope for rate cuts. Keith Lerner of Truist saying this: stocks should remain supported by a resilient economy, record forward earnings estimates, and positive technical trends. We see more upside than downside potential for equities over the next 12 months. Keith is with us for more. Keith, buddy, good to hear from you. As always, constructive by the sounds of it. Can you just tell us how the data from Friday maybe influences those views?
Yeah, well, great to be with you, especially starting off this week. So, Jonathan, after the first quarter, we had that big 10% plus gain. We came off of 5 months of gains for the overall market. And when you see that really strong type of momentum, that tends to be a good thing, but it also leaves you vulnerable to a short-term setback that we saw in April. And we use that opportunity, that 5% pullback, to actually increase our equity position. And now, specific to your question around the payrolls, I know people are characterizing it as weak. We think it's actually relatively solid. It's just more normalizing from a really strong level. I mean, if you have anything around 175, that's a strong number, and that's still above the pre-pandemic trend. You did have some positives as far as the inflation side cooling a little bit. You guys talked about this earlier. Wages cooling as well. It's one number. That one number, I would say, was more Goldilocks. I mean, there was some offset from the ISM services that you discussed as well. But all in all, I mean, that number was a positive, and the market reacted accordingly.
You've upgraded equities, you downgraded cash. You also upgraded bond duration, Keith. Can you walk us through that and how it complements the other moves?
Sure. So when we had that pullback of about 5%, and then when yields were closer to 470 in the 10-year, we basically said this is a point to deploy some of that excess cash, which we know a lot of investors still have. And the way we think about the duration, we downgraded duration back in mid-December when we were around 390. As we approached 470, we just thought the risk reward had improved, not trying to call the top. But we also, at that point, the market started to embed, basically only one rate cut. So we think the market moved too far. And as you saw, we see some relief. We still think the 10-year Treasury is probably still in a broader range. Maybe, this 425 level is going to be important, but maybe 4% on the downside and maybe around 5% towards the upside. So again, I think it's more of a tactical trade. I think that supply that you all talked about is probably going to keep the low end of that range higher than it had been previously. But all in all, I think the risk reward improved as we rebounded in yields.
That was right where I wanted to go, Keith. How much of this upgrade to equities and duration is a tactical play simply to piggyback on the sell-off?
Yeah, I mean, that's it. I mean, the way we think about it is, again, we were stretched on a short-term basis. Sentiment got a bit stretched. And even our studies, when we look at like a first quarter where you're up over 10%, you look back historically, it's happened about 11 times since 1950. By the end of the year, you've been up 10 out of 11 times. But one thing that we talked about a lot is the minimum drawdown you see at some point, the minimum was 4%. So our message was, we expect market to move higher, but it's not going to be a smooth path. And then we overlay the forward earning estimates, which you highlighted earlier, Jonathan, which are moving at an all-time high. And I think with all the volatility and the uncertainty and the data dependency of the Fed, the one thing, overall that has been pretty steady has been forward earning estimates continue to make new highs each week. And if you think about it since the pandemic, think about what these corporations have faced: a once-in-a-lifetime pandemic, once-in-a-lifetime inflation shock. And what we see is that companies adjust and earnings continue to move higher. And I think that's something where we're more focused on than the day-to-day movement in interest rates.
When you say these companies, are you talking about U.S. companies, or are you talking about more broadly?
Yeah, I heard the discussion about the globe, this morning. I think, listen, we're more specific on the U.S. I do think we are seeing some better trends globally. But, even if you look at the economic numbers, which is what the main driver of earnings, the U.S. is driving the global GDP revisions upward. China's actually, just over the last month, we've seen the first revisions in some time. But if you look at Europe and Japan, those GDP revisions continue to move down and they're sub 1%. So we still have a more favorable view of the U.S. overall, but those companies, the innovation, we still think is in the U.S.
Well, the U.S. economy or U.S. markets? And Keith, the reason I asked that is sure that Chinese growth isn't tremendous, but Chinese equities have ripped since February. So I want to understand from a market performance perspective just how exceptional the performance in America actually is.
Well, it's exceptional because the biggest driver has been the big tech companies, and that's also where the big earnings have been as well. So, listen, I think as we think about longer term, we still think the U.S. and the innovation, because they're global companies, right? They're selling global AI to the world and other software and so forth. The one thing that would get us more constructive on the international side would be to see those international earning trends start to move up, and we're not seeing it in the same way as the U.S. So that's what's keeping us in the U.S. We're open-minded to a shift, maybe because China gets a little bit better, that feeds into Europe, but we're not seeing it in the earning revision trends yet.
So just to narrow it down on leadership, geographically it's still America. On a sector basis, Keith, what is it? Is it still tech?
It's still tech. We're still overweight tech and communications, but we have broadened out to have things like industrials. I think energy is still a decent hedge as well. So it's not just tech this year, it's pouring out, but I still think it's hard to be negative on tech longer term. One of the reasons why tech outperforms is when the earning trends outperform the other sectors. That is still happening. And that's the other thing that we watch in our process to say, is there a shift? We haven't seen any give up on that overall trend as of yet.
Hey, Keith, good to hear from you. Keith Lerner there of Truist. Upgrading equities following the small pullback we've seen in the last month or so. Upgrading bond duration to more attractive as well. Downgraded cash. Looking to unlock maybe some cash in money market funds sometime soon as we start to talk about rate cuts all over again.
Yeah, essentially, if you're not going to get that 5% or 5.25% yields, maybe lock in something longer. I thought it was also interesting, and he didn't talk about this, but he thinks that gold and commodities, after their brief pullback, is a place to go. I wonder how many people who thought of gold as a pet rock are now coming around to actually seeing it as something that is more potentially valuable in a portfolio, like Wei Li was talking about.
Rallies do that, don't they? Isn't that what happens?
Well, I mean, yes, they do. I mean, I think in this case, there's this question about central banks. There's a question about Chinese consumers, lots of gold-infused weddings. I don't know.
Gold-infused weddings?
I don't know. There was a time when people would buy gold depending on when the Indian wedding season was.
Of course, yeah, I remember that.
Yeah. So I don't know if that's never been...
Do you remember that guy who had that shirt made of gold? Do you remember that? It's like more than 10 years ago. Do you remember that famous picture? I'll send that to you in a commercial break. Give me a sec. Equity futures on the S&P, positive by 0.4%. Here's some stories elsewhere. Your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. So we are off the best two-day run in 10 weeks for U.S. stocks, and already the doubters are circling. Goldman's David Kostin says that election volatility hasn't been priced in. Our BCA's Rukai Ibrahim says there's still elevated odds of a recession late this year or early next. Ibrahim spoke with me earlier on Bloomberg Brief.
U.S. equities are already extremely highly valued, and so I think that raises the likelihood that they're more vulnerable to the downside. In our expectation, if we do get this recession late 2024, early 2025, the S&P 500 is most likely going to fall to around 3,600, and that's due to our expectations on growth estimates and on the forward PE.
Just to put that into context, 3,600 on the S&P would imply a nearly 30% decline. Now, Robusta coffee has climbed to the highest price in 45 years, that according to the International Coffee Organization. In April, prices rose 17%. It was a supply crunch that intensified for a variety of coffee used in espresso and instant drinks. Poor harvests in Vietnam have badly affected production, and now a drought and a heat wave threaten upcoming harvests. Let's get you a quick check on Spirit Airlines in the pre-market, weaker by more than 3%. It had a wider than expected loss in the first quarter, blaming bad weather and air traffic control delays. The results do emphasize the tough go for Spirit that it will face as a standalone company. You'll recall a judge had blocked its merger with JetBlue earlier this year. Spirit also said that 25 aircrafts will be grounded through the rest of the year. That's about 1/8 of its fleet. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. The latest from Goldman. Their note just dropped in my inbox. I'll share some of it with you just quickly. Chairman Powell's press conference at the May FOMC meeting was dovish. The April employment report was softer, but not weak, their view. Continue to expect 2 rate cuts this year, July and November. July. Holding on to July.
A lot of people are. I'm really distracted by this gold shirt. It just is really amazing. Evidently, a 45-year-old magnate in India.
I forget the gentleman's name. It's quite a shirt.
He thought that it would make him good with the ladies.
Oh, right. Would help him get married.
Yeah, Pankaj Parak.
Oh, right.
Yeah.
Sort of like playing into marriages, though.
Correct.
By buying the shirt.
And then,
Sort of getting ahead of the trade, if you will.
And I saw that it doesn't need to be ironed. So it's,
well, because I mean, Lisa, obviously, even if you wanted to,
I think it would be heavy, right?
Okay.
It's
All right. Sidetracked on gold. Up next on the programme. The morning call's just around the corner. We'll catch up with CFRA's Ken Leon on his Live Nation downgrade, citing antitrust concerns. Saw some of that in the note from Goldman, from David Kostin this morning. More on that up next. Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Coming off the back of 2 weeks of gains on the S&P 500, equity futures shaping up as follows. We're positive by 0.4%. Let's get you some morning calls. First up, Citi, downgrading Peloton to neutral, encouraged by third quarter results, but awaiting details on strategic direction once new management is announced. Your second call from Baird, upgrading Micron to outperform, adding the stock to its list of top semiconductor ideas. The analysts seeing meaningful upside opportunities ahead for the chip maker. And finally, CFRA downgrading Live Nation to hold, citing investor worry about overhang of the DOJ's review of the ticket sellers' business practices. Ken Leon of CFRA, the director of equity research, saying this: at quarter end, unearned revenue on future concerts was $4.4 billion. We're positive on Live Nation sponsoring 80-plus worldwide concerts in 24 for Taylor Swift's The Eras Tour and other big artists that benefit Ticketmaster and select venues. Ken joins us now for more on this conversation. Ken, let's talk about the overhang first before we talk about the reasons to be positive. This DOJ overhang, what do you think the end result's going to be?
I think there's going to be some tweaking in terms of best practices for Ticketmaster. And John, I really want to set the stage here. There's 18 to 21 analysts with a buy. We went to a hold. There's still euphoria of consumers moving from product to experiences. And Liberty Media, John Malone owned 23% of this company. So, and all the media analysts are just have fatigue with video streaming. So why not Live Nation? We beg to differ because the businesses are kind of different. Concerts is almost like the supermarket, a loss leader. It's 80%, over 80% of revenue, but doesn't really make money. But that feeds into advertising and sponsorship. Ticketmaster, the tickets, is only 13% of last year's revenues, but it's the majority of the earnings. So that's the area to focus, and that's why your question, John, on the DOJ, on what will they do to maybe constrain this business is a concern.
There's lots of overhangs more broadly elsewhere, not just in this sector, but also for big tech, Ken. This came from David Costin of Goldman. Risk linked to lawsuits filed by U.S. authorities against big tech companies may also be underpriced. Ken, my question to you would be, how are you meant to price this?
They have a dominant position in terms of ticketing, and fairness to management at Live Nation. They have put proposals, even to Congress, to make sure that scalping of tickets, some way there's more transparencies and better control of that. And I think for consumers, that's what they want, where they're exasperated when they can't get a fair price for a Taylor Swift or any major artist. So that will continue. But I want to point out again, for Live Nation as an investment, they're very concentrated to the Ticketmaster business. And we don't see this large exponential growth for the company, which is why we have a $105 target, not $118, which is where the street is.
Ken, aside from Live Nation, there's a larger question about Department of Justice hangovers with a whole host of different industries and companies. I'm thinking, for example, of some of the bids to buy Paramount. We were talking about that earlier, a question of, is it a problem, not necessarily Apollo, but Sony with national security, considering the fact that it's not a U.S. company and there's going to be broadcast material. At what point are there certain industries that are immune from antitrust oversight and certain industries that are going to be that much more subject, and you have to price in a very high risk premium?
It's a great question. And I think corporates have to be very smart about what they do on acquisitions, either vertical or horizontal. In the case of Apollo and Sony, you also have issues related to FCC licenses. But I think deals can get done. Where it becomes a big problem, Lisa, is, of course, concentration. And given that the world has changed, in this case for entertainment, with the likes of Meta, Google, Amazon, Apple coming in, you know, whether you put two studios together, and we have a buy on Paramount at CFRA. I also, as you know, Lisa, cover financials. I cover Apollo. I think that's the right deal. And it's interesting, Paramount's former independent director who left, along with 3 other directors, because there wasn't fairness for public shareholders, was the former president of Sony USA.
I guess that heading toward the election, this has been something that a lot of companies have been talking about, including Brian Moynihan of Bank of America, that a lot of companies and corporate executives are not willing to pull the trigger on certain deals because of this concern about what could happen with the Department of Justice. Are you hearing or seeing that soften, that there is a sense that maybe on a case-by-case basis, things are going to start getting done in a way that they haven't over the past few years?
I think corporates at large are going to have measured risk. And I think what's factoring now is that rates are not going to zero. So the views in terms of buyers or sellers across industries is that, well, rates are going to be kind of where they are now. So when you look at cost of capital, return on investment, how you want to fund a deal with equity and debt, those calibrations are already happening. So we're very optimistic for a very improved mergers and acquisition and equity underwriting market for the rest of this year.
Even in banks at a time where a number of them have said, we need to see mergers and acquisitions, but unless your name has First and Republic in it, it probably isn't going to happen.
That's right. And I'd go back to last week to Jay Powell, because one of the questions most important for the banking industry, particularly the largest banks who would be the acquirers, is the Basel III endgame. Put that all in English. The worry for investors is whether the regulators would require a higher capital increase. There's been pushback not only from the banking industry, but also Congress and its effects on the U.S. economy. So I think with the banking industry, acquisitions will be done when the large banks are comfortable with regulation. And then again, when we look at the smaller banks, which have less impact for investing, but they're really important for the U.S. economy.
Ken, just how tight are lending standards at the moment? 1 year ago, we were meant to be going into recession following a regional bank crisis, if we can even call it one now. And the idea was that ultimately these banks would need to pull back. And the biggest data point every single quarter would be the Senior Loan Opinion Officer Survey, because, Ken, that was what was going to strangle this economy. Just how tight are lending standards?
I think it's conservative around the table, but there is availability of credit. There's also different alternatives that you have, not only from bank loans, public credit, but also private credit from the large firms, as we mentioned before, like Apollo. So I think at this point there's opportunity, but it's nowhere where we're in a risk-on environment and they're letting borrowers have high leverage ratios.
Ken, wonderful to hear from you, sir. Ken Leon there of CFRA on a range of issues. Bramo trying to make SLUs great again. Bob Michael of JP Morgan Asset Management. What did Bob say last week? Or the week before? I forget. Basically said it doesn't matter as much as it used to because the financing has come from elsewhere. And you heard what Ken said there about private markets.
Yeah, in other words, he made it less interesting too. Basically, you were saying, please, can you make this something that we're going to watch?
Water.
Yeah, nope, not going to do it. Which is the reason why I think a lot of people have had a really hard time understanding this economy. That essentially, if you do have that credit impulse coming from private credit, if you have it coming from other private sources of capital, how do you really get a gauge on what the lending conditions actually are? It is tough.
It speaks to that bifurcation in the economy. Not everyone can tap private markets and public markets more broadly, right?
That's correct.
That's not available to everybody.
At the same time, we've actually seen some of the laggards actually do okay, right? Triple Cs have outperformed in certain environments. It's been a tough time.
Super tough. Equities right now, positive by 0.4%. It might be a tough week, given there's nothing to talk about.
We're trying.
We'll make it happen. City's Veronica Clark, looking ahead to Fed speak. That's coming up next. This is Bloomberg.
of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Coming off the back of the longest weekly winning streak, going back to March. 2 weeks of gains on the S&P 500, that's all it takes. Equities just moving forward last week, following, inspired by a little downside surprise on a payrolls report. That got us going into the weekend, and we build on it coming out the other side. We're up by 0.4% on the S&P, up by a third on the Nasdaq 100, on the Russell up by 0.9, and we are earnings light until we get NVIDIA, I guess, May 22nd. Just in terms of the mega cap tech names, there's only still one to come.
Basically, next week we get CPI and we get NVIDIA, and that's going to really, I guess, kick things off in a way that maybe this week not so much. Although Disney should be interesting. What they do with their things and, you know.
What they do with their things is the tease for Disney and the conversation with the CFO tomorrow morning. Live on Bloomberg.
Oh, come on, that was mean. No, look, it's,
We can do it again. Coming up tomorrow, what they do with their things. Yeah. Switch at the board and get to the bond market. You can't even pretend to be excited about anything else apart from bond supply, so let's talk about it. 478.66 on a 2-year, on a 10-year, 447.11. Tell us why it matters.
It matters because we've seen some softer than expected auctions. This has been a time where the Treasury Department's been managing quite effectively, people say, selling on the short end of the yield curve, basically shorter duration notes, so you haven't seen the same kind of increases in size in the long end. That's going to change. So I'm curious about how well these are being absorbed, how much people are diving in to get that income, and whether that can be sort of a sense of when they can increase later on.
Yields down for 4 straight sessions going into all of that.
How'd I do?
Pretty well. Foreign exchange looks like this. Euro, dollar, dollar yen. You don't need my endorsement. Dollar yen 153.51. We're positive there by a third of 1%. Looking at the euro, a little stronger, 107.84. Data's getting a little bit better. I know it's not great, but it's getting better in Europe. And we had a conversation earlier this morning about how we're going to close this gap. If we are going to close this gap between the US and the rest of the world, will we be talking about convergence or divergence? And if it's convergence, is it something getting better or something geting worse?
We've been great on this, basically relative to what, right? And basically the data in the US has been actually surprising to the downside more frequently, whereas what we saw earlier this morning was surprising to the upside when it came to services and the composite PMIs over in Europe. So this raises a question, okay, have people underpriced the strength of Europe and overpriced the exceptionalism of the United States?
Well said. More on exceptionalism with Peter Cheer a little bit later. Let's talk about some things under surveillance this morning. Chinese President Xi Jinping looking to strengthen ties with Europe.
You're never going to let me live that
Xi
down.
Jinping beginning his week-long trip to France and elsewhere, focusing on China's trade relationship with the EU as leaders align with Washington opposing Chinese overcapacity and overproduction. This came from Macron in Politico following a trip to China last year. The worst thing would be to think that we Europeans must become followers on this topic and adapt to the American rhythm or a Chinese overreaction. He was talking about a whole host of things a year ago. But do you think that Xi senses an opening there to have a different kind of relationship with the Europeans than the one with the United States?
Some people have put it more bluntly. How much is Xi Jinping going to exploit the divisions, the increasing fissures in the allies' relationships to try to get a leg up, and not just with respect to the U.S. and European countries, but within Europe as well? Because he's not going to all of the countries. He's not going to Germany. So how much is he going to appeal to countries that more aggressively would like to see the disinflation from Chinese goods and are more open to their products being sold
I just wonder how Americans will tolerate this position. And by Americans, I mean the US government, of course. So if you think about President Biden, his focus is multilateralism to make sure that allies are good allies and we remain good friends to those allies. Got all of that. How much will the former President Donald Trump hit the campaign trail and say, hang on a minute, if you want security guarantees from us, don't expect to have an increased economic relationship with China. You can't have it both ways. And this has been the approach from Europe for a long time. Sit on the fence, try and get the best of both worlds from each side. I still wonder how sustainable that would be under a Trump presidency.
Even before we get there, the lack of dependability on what the U.S. position is going to be has to leave a lot of countries saying, we have to go it alone and we have to do what's best for us in absolute terms, not necessarily what's going to be best for us with respect to our relationship with this country or that country, because it's not a stable backdrop. And we're hearing that a lot from a number of officials.
Key topic going into November. Elsewhere, Israel telling citizens in the Gaza city of Rafah to evacuate, a likely precursor to an attack. The move comes as ceasefire talks stall, Hamas insisting that any agreed upon truce should be permanent. Hamas over the weekend launching one of the worst missile attacks in weeks, killing 3 Israeli soldiers, Lisa, at a border crossing.
And it's not just any border crossing. It was one of, I believe, the 2 places where humanitarian aid could be transported from Israel into Gaza. So really severing one of the ways that people could get food and other resources in Gaza. Everyone wants this to end, or anyone in the Western world wants this to end.
Of course.
And globally, people watch this, and it's horrific. Question is, how do you get there at a time where Israel is more and more isolated, and where Hamas seems to be holding on to survival as their preeminent concern? It becomes a very difficult thing. I don't have a sense of who has influence where.
I'm not sure anyone does. At least it's a tremendously difficult situation. Let's turn elsewhere to Fed speak, picking up again this week. Presidents Barkin and Williams speaking later on today ahead of a parade of Fed officials the rest of this week. Traders looking for clues about the FOMC's path forward after a soft April payrolls print and a weak ISM as well. City's Veronica Clark joins us around a table here in New York City. Veronica, I mentioned the City quote a little bit earlier. Summer doving happened so fast. I think we should say up front that was Andrew Hollenhorst, that was not Veronica.
It was not me.
It was not you.
It was all Andrew.
Good. You do not want to take responsibility for that. Let's talk about how quickly this conversation could switch to rate cuts this summer, which has been the base case for you and the team for quite a while.
Yeah. I mean, I think we saw the early signs of that last week. We heard from Powell, of course, on Wednesday, and I think it was important to us that he really didn't endorse this hawkish repricing that the market had experienced over the last couple weeks. And I think this is a Fed that is still just waiting for a little bit more confidence on the inflation data, just a couple more months of a softer pace of inflation after that very strong Q1. And then, of course, on Friday, we had softer employment data, and that is something that certainly could get the Fed to get more dovish.
Let's talk about Friday. So you were below consensus going into the number. You were talking about downside risk as well. We got that downside risk. It materialized. Why do you not see that as a one-off? Why do you see that as a sign of more to come through this summer?
Yeah. I mean, also, 175,000 jobs is by no means a weak pace of job growth. On the surface, this could still be a pretty strong employment report. I think the issue for us, though, is that for some time, 4, 5, 6 months now, we have seen a lot of other labor market data that have been deteriorating. The hiring rate in the JOLTS numbers last week, that's been coming down. We saw that in the employment subcomponents of these ISMs, PMIs, a lot of signs that point to hiring really slowing. And this is the time of year when you would normally be hiring a lot of people. And I think this is finally where we're starting to see the very consistently strong payrolls, which is almost an outlier that's starting to crack now.
You sent out a note as we introduced you while we're on air, and you talk about how New York Fed President John Williams is likely to affirm Powell's concern about the labor market and increase focus on the employment mandate. He's going to speak today at 1 p.m. Why do you think he's going to lean into that at a time where a lot of people take Jay Powell as uniquely dovish and frankly pointing to a rate cut a lot sooner than previously?
Yeah. I mean, I think Williams is generally one of the more dovish officials that we hear from. And I think, Powell does speak for a lot of the center of that committee, and Williams is part of that. It is important to hear that confirmed in the other speakers. But it was a pretty interesting shift that we heard from Powell, I think, on Wednesday. Back in March, he was saying that there are no cracks, in the labor market data. And on Wednesday, one of the first questions about, how do do we know that rates are restrictive? He answered that with, well, look at all the signs that we see that the labor market's coming into better balance. He pointed out that falling hiring rate, some of the surveys that are weaker. So I do think this is Powell and the center of the committee that are getting worried about the employment side.
John's been really good on this and just saying how much has the balance of risks or balance of weightings changed since Fed Chair Jay Powell spoke? In other words, how bad does the next print, the next two prints have to be? How weak does the CPI report that we get next week have to be to reintroduce the idea of a July rate cut?
Yeah, I think the more slowing in the labor market data that we see, maybe the bar gets higher for what is bad inflation data for the Fed. So I don't think they're going to be too reactive to the data that we saw on Friday. Again, 175,000 jobs, a low unemployment rate, 3.9. That's still a pretty healthy print. But I think as you're getting to 4% unemployment, a bit above that, that would definitely get more worrying. And on the inflation side of things, I think you just need a couple months where core PC inflation is running 0.20, 0.25, softer than February, March that we saw, but not dramatically softer. I think that's enough to do it.
Jay Powell laughed at the idea of stagflation, or just basically dismissed it and said it doesn't believe in the stag or the inflation, brings up the 1970s. Do you think that there is something that rhymes uncomfortably with that in the services read we got Friday?
I wouldn't say yet. I mean, I do kind of agree with Powell. I don't think we are in that environment now. We could see some stickiness to inflation, absolutely, but something that's more stuck at around 2.5% to 3% inflation, not a big reacceleration. And typically, you would expect to see activity data weakening first, and then with some lag, you would see that show up in softer inflation. So we might have a period that even looks more stagflationary, where activity data is weak and inflation hasn't slowed yet. But I think Fed officials would think that inflation slowing is coming.
We're trying to work out, Veronica, whether these are the early signs of companies worried about inflation but ultimately losing pricing power, protecting margin by laying off workers. Are we starting to see that develop?
I think we are seeing signs that businesses are looking to cut labor costs. That's why we see the hiring rate falling. We had some anecdotes in the ISMs last week about not replacing workers if they happen to leave. We've seen hours worked coming down, more part-time employment, all those early signs that businesses are looking to cut labor costs, and layoffs haven't really happened yet, but that would be the last step.
Would you just imagine the Fed will see that as inflation comes next? Is that the leading indicator for inflation? Because I think a big feature of your research, and if our audience at home aren't too familiar with it, you believe this Fed can cut with inflation closer to 3 than 2.
I think, it's a matter of priorities. They're going to be more focused on that employment side of the mandate, and they will be thinking that, if you start to see the weakening in the labor market, weakening demand, that should mean that wages are slowing, and that should mean that inflation is also slowing eventually.
Can we get the economist perspective on an argument we've had all morning? Not an argument, a debate. We don't argue here. Different channel. Debate. Intellectual stuff, Anyway.
Unless it's
I'm going off on one, Bramo.
Carry on.
Whether this is a feature or a bug of Fed communication, the wild swings, and I understand you haven't changed your base case at all, more recently anyway, but we've seen massive swings in market pricing to go from 7 cuts to 1 to 1 to some in just a couple of data points.
It's amazing.
Is that a feature or a bug of communication?
I don't know if so certainly we haven't gotten the clearest communication from the Fed. We know that they want more confidence, but what is more confidence? What does that look like? So it is a bit of a communication issue, but I think it's also just a data issue. There's not a good, clear signal in the data right now, and markets are very sensitive to every little data point then.
Another argument we were having, and it was an argument, was about the long and variable lags in the mortgage market, in particular in the housing market. Do you buy into this argument that if the Fed cuts rates, that'll unleash a lot of sales that will then drive prices down?
That's tricky. We actually have seen in the last 6 months or so that new listings of homes have been coming up some, and we have seen some softness in prices. Maybe that is related to earlier this year we had mortgage rates much lower than they are now, so maybe there is some of that. But I think in an environment where the Fed is cutting, and it's because of an economic backdrop like we see, a weakening labor market, that is weaker demand even for housing.
I mean, it links to this question of, is it a feature or a bug? Does all the volatility matter if it doesn't have an effect?
Yeah, good question. I mean, maybe at some point it is going to have an effect, and I think we are in that hard part now. You know, we went from the soft landing narrative to the no landing narrative in the Q1 of this year, and that stickiness of inflation is where you get then to the hard landing.
Veronica, enjoyed this as always. Veronica Clark there of Citi, breaking things down on the Federal Reserve with tons of Fed speak coming up. A little bit later, we'll get John Williams of the New York Fed.
Yeah, honestly, to me, this is a key question. Does he lean into what we heard from Jay Powell, or does he end up really kind of going his own way and saying we have to see? To me, it's going to be the key threshold for how much do you end up with a new balance of what it would take to cut rates.
Let's get you some breaking news. Breaking just moments ago. We can get that with Sonali Basak. Hey, Sonali.
John, we're learning now through an SEC filing that Robinhood has received a Wells notice from the SEC. You are seeing Robinhood shares react significantly to the news here. You are watching this Wells notice in relation, by the way, to the cryptocurrency listings on the Robinhood exchange. Remember, increasingly in recent years, Robinhood has catered to a customer that has not only been interested in stocks, but from cryptocurrencies as well. The Wells notice was on May 4th, and the preliminary determination here was to recommend an enforcement action against Robinhood Crypto, alleging violations of Section 15A and 17A of the Securities Exchange Act. And this is all according to a regulatory filing before market open today. Shares fell as much as 5.5%. You see it moderating some now. We know this is all in vain, John, of the SEC looking further at exchanges listing different cryptocurrencies and the manner in which they do so. Of course, the traditional crypto exchanges, such as Coinbase, have also been battling the SEC when it comes to the cryptocurrency world as well.
Sonali, thank you. That stock is lower by something like 1%. No drama yet, at least in the pre-market. Up next on the program, just how exceptional is U.S. exceptionalism?
U.S. is going to remain exceptional. It is the only major economy in the West that is seriously investing in tomorrow's engines of growth.
We'll have that debate next with Peter Cheer of Academy from New York. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
For 4 days, yields pulling back. Continues today. We're down 3 or 4 basis points on a 10-year. Let's call it 447. In the equity market, up by 0.4%, going into the opening bell about 43 minutes away. Under surveillance this morning, just how exceptional is U.S. exceptionalism?
The U.S. is going to remain exceptional. Its growth performance may not outpace others as much as it has, but it is the only major economy in the West that is seriously investing in tomorrow's engines of growth. And because of the role of the dollar, it can run an irresponsible fiscal policy for much longer than others can.
The privilege of behaving recklessly. We've talked about that a lot on this programme. Here's the latest. Investors taking stock of a weak April payrolls report. The data fueling chatter of Goldilocks and US exceptionalism. But Peter Chair of Academy Securities wonders if the happy talk is over.